introduce to the bond market. So we all know the high yield market's yielding, call it 8.5, but the coupon in the high yield bond market is like 6.5. So there's 200 basis points of spread there as those bonds start to mature over the next 2 years, and there's roughly $2 trillion worth of IG, high yield, and loans coming due over the next 2 years that are set to reset at presumably not loans, but in IG and high yield. So the longer you leave rates up there, the more refinancing risk you introduce for let's say the equity and the credit markets. And if you listen to someone like, let's say, Barry Sternlicht or anyone in the real estate market, they'd echo a similar theme from a different viewpoint, which is from the real estate market, the longer you leave rates up there, the more difficult it is to get all these deals done. And we know that obviously offices in real, or certain parts of offices in real trouble. And again, I can't emphasize this enough. I imagine many viewers know it. 6 months from now, if rates are still 5+%, we're going to be having a much different conversation than we are now.
I'm shocked that real estate moguls don't want rates up here. Shocked.
Although they're all raising money for distressed real estate funds.
Every time I see those headlines. Dan, let's finish there. You mentioned it. For someone like you, when do you start to worry about that? We understand the maturity profiles of certain companies and when that maturity wall is going to hit. Let's say it is out there, end of 24, start of 25. When do you start to back away from some of those credits ahead of that?
Yeah, the problem you wrestle with as an asset manager, as a fund manager, is when I advise our CEO and CIO and say this is what we should do or this is what we should think, there's a catalyst component to it. And otherwise, it's just, to borrow a phrase from earlier in the discussion, a white noise. And in terms of when you get real, I think to oversimplify this conversation, to touch on something about the consumer that you mentioned earlier, at the end of the day, this is all about the labor market. And if the unemployment rate stays in the mid-3s and wages are doing fine and prices continue to fall, then the economy should, on balance, do well. Now, obviously, that's separate from the rate conversation, but it's hard to make the case that things are going to get meaningfully worse if the labor market stays where it is.
And right now, it's at 3.5%. Dan, it's good to see you. Thank you, sir.
Thanks, guys.
Thanks for being here. Dan Greenhouse of Solace Alternative Asset Management. On China, US retail, this bond market. And this bond market is getting trickier and trickier by the day for treasuries.
And I just keep thinking about what Dan just said, which is it's all white noise until it isn't, right? It's all white noise until the labor market cracks. And that's what I think we're looking at. When does it crack and when does it become something more?
Pretty depressing stuff, Bramo.
Well,
you know, on brand. If you're just tuning in, welcome to the show. On the S&P 500, we're negative here by 0.6%. Coming up a little bit later on this morning, looking forward to catching up with Bob Dole of Crossmark. We'll catch up with Bob in about 48 minutes from now. Lisa, as we look ahead to retail sales in about 1 hour and 20 minutes.
And so some people are saying, well, just wait. Retail sales will start falling off a cliff. They've been saying that for a while, right? And they're going to reaccelerate. And now people are saying it's Amazon Prime Day. So everyone went out and bought all the deals. So at what point do we just sort of throw in the towel and realize the consumer is just going to keep on buying?
On the domestic front, you have seen some subtle signs, small ones, from earnings. JetBlue, Southwest, some of the domestic-focused airlines flagging softening demand and dropping fares, we're told. I haven't witnessed that yet, but apparently fares are coming down domestically.
Okay, that said, how much is it just this great rolling ball of money that's going from one area to another? It went away from goods, it went to services. Now people are sick of flying around everywhere, and now it's going to go back into another part of the economy.
Where's it going next?
I don't know, maybe back to school supplies. I don't know, just theoretically. I will say this, people are waiting for the student loan repayments to crimp some of the dynamism that the U.S. consumer has. But do you know that 45% of borrowers say that they're not going to repay, that they're going to actually just be in default for the first year, and that they don't have to get repaid anyway? I mean, this is according to this is Credit Karma.
I wish we had more time on the clock, because Dan Greenhouse had a corner of my eye. I know he's got things to say, and he's not got time to say them. Equity futures on the S&P 500, negative here by 0.6%. Live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis.
We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Every individual charged in the indictment is charged with one count of violating Georgia's Racketeer, Influenced, and Corrupt Organizations Act to accomplish the illegal goal of allowing Donald J. Trump to seize the presidential term of office beginning on January 20th, 21.
Quite a statement. Fannie Willis there, the district attorney of Fulton County, Georgia, laying out the indictment against former President Donald Trump and 18 others over efforts to overturn the results of the 2020 presidential election in the state. In a statement, Trump's attorneys calling the charges, quote, shocking and absurd. Lisa, we're losing count of the amount of cases here, aren't we? We're on to 4?
Yeah, this is on to 4, and a lot of people are looking at this one in particular because it is a state case. So even if Trump does become president, he cannot absolve himself from this. He can't pardon himself, and that's one thing people are looking at. I personally am watching to see whether it's going to be televised and whether that's a good thing or a bad thing for the former president's presidential aspirations.
His campaign.
His campaign, yes.
Will it be on the stage next week? I ask that every single day. Is he going to be on the stage next week?
People don't know. We hear from Chris Christie saying, yeah, he will. He'll come, because that's what he wants. But we shall see. His advisors, I'm sure, are saying, don't go.
I forgot who said it yesterday. There was a 2% chance, and 1 point of that was his ego. And that 1 percentage point was kind of important.
And that's kind of 80% of everything that he does. So there you go.
So there we go. If you are just tuning in, that's one big story for us. Another is China. So allow me to go through some of the price action, just get you up to speed on what's happening elsewhere. Equities are lower by 0.6% on the S&P 500, as you were in the Treasury market. And if you've been following the Treasury market, as you were means one thing, yields up, Treasury's down, 422.87, yields higher by 4 basis points. Lots of concerns about what's happening over in China. The data wasn't great. We've had the biggest rate cut, Lisa, going back to 2020, and a strong suggestion there needs to be a whole lot more than that.
And the strong suggestion bearing out in equity markets where you see Chinese equities selling off despite the move for support. This, again, points to this feeling that they need to do more, and they're unwilling to do that, at least in any measures that they've laid out so far. It is not a bazooka, as one commentator said.
It's quite telling that markets haven't responded to this positively. You might expect maybe a rally in the equity market, a rally in treasuries, yields dropping, maybe even copper, base metals picking up. I'm not seeing that.
They have some fundamental problems with people just not going out and buying. How do you deal with that if people don't feel optimistic enough to go out there and spend? And that is what you've seen in the behavior of the reopening of China. And it does go to the youth unemployment rate. It does go to the fact that they don't see where they're going to get jobs, although we don't know because they didn't release it.
Well, you won't see it anymore.
Because it's going to be optimized.
They're optimizing it. You want the full quote on the optimization?
Please.
The National Bureau of Statistics, according to a spokesperson, they said they won't be publishing youth unemployment anymore for the time being because they need, quote, further optimization and more research needs to be done. And here's the quote. This is the official line. Whether students looking for a job before graduation should be counted in the labor statistics.
Okay, here's my issue with all of this. Does anyone actually read this and say, oh, okay, well, this is good news? Then we won't trade on this and we'll just assume the best? Or is it basically just they're trying to figure out how to get their messaging correctly for the next read? I mean, basically, what does this do to the credibility that they don't really necessarily have developed in markets with respect to the integrity of their data? It just sort of it doesn't really necessarily affect things that much.
It's not for us. It's for domestic consumption, right? You'd have to imagine that's what it's about.
And I wonder how much the domestic consumption is, nods along versus is like, okay, here's another thing that we're going to have to stab in the dark with.
Let's head down to D.C. and catch up with Bloomberg's Wendy Benjaminson over in Washington, D.C. Wendy, wonderful to catch up with you. We've talked about the former president, some of the legal issues he faces in New York, Washington, D.C., in Florida. Talk to me about Georgia and what's different about this case.
Well, first, as Lisa said, it is very important because were he to be reelected, he could not pardon himself. Fani Willis, the prosecutor in Atlanta, does not answer to Donald Trump, nor do the people of Georgia necessarily. But the other thing that's really different about this case is the size and scope. It was, just by the numbers, it's a 98-page indictment with 41 criminal counts against 19 people. This isn't just Donald Trump and a bunch of unindicted co-conspirators, as we saw with the last election interference case from D.C. This is Rudy Giuliani, a host of his other lawyers. Mark Meadows, the former White House chief of staff, is ensnared in this. And I think what's really important to remember is that we know they did all these things. They were playing out in real time. We were doing daily stories about their attempts to overturn the election. The big question now for all these prosecutors is to convince a jury that these were crimes.
When will this actually start to matter in terms of the popularity ratings of Donald Trump? This basically has been a boost to his popularity, if anything. Will it continue to be?
Well, we'll have to see how this plays out once it's past the prosecutors accusing him of crimes. I think once we get into the discovery, once we start seeing the evidence pile up, once juries start reacting to it, and once it's on trial, I think maybe there may be some diminution of his popularity, and there already has been among moderate Republicans, independent voters, and of course every Democrat. But there's, but I think perhaps, and I've been saying things like this since 2015, so who knows if I'm right. At some point, people will see Donald Trump for who he is.
There's a question going forward about what the other candidates to become the Republican nominee are going to say about these cases. Originally, they rallied behind the former president. Are they still?
Yes, and I just don't understand the campaign strategy, let alone the authority or whether they're right or wrong on this. It's Vivek Ramaswamy came out, I think it was overnight, and said, yeah, I would write the amicus brief myself, telling them to overturn this. And Ron DeSantis and the others are talking about the weaponization of the quote-unquote Biden Justice Department and all of that. And then there's the what about Hunter Biden reaction. And I don't understand how you run against someone while you're defending them. It's an odd strategy, but maybe that's the way they think they will become more popular with primary voters, but it's not happening. And it'll be really interesting to watch the debate, even if he doesn't show up, if it becomes isn't a Donald Trump great, we all agree, debate.
Well, we know not everyone's going to say that. The former Vice President Mike Pence is one. Another would be the former New Jersey Governor Christie. Wendy, is that helping them or hurting them?
Well, combined, they have about 8 or 9% of the Republican primary support, so I don't know. They've become much more popular with independent and suburban and Democratic voters for, standing up to what they believe were crimes happening. But it's not helping them with Republican primary voters. Right now, the biggest competitors to Donald Trump are, and by this, they are distant seconds and thirds, are Ron DeSantis and Vivek Ramaswamy, and they are defending him.
Wendy, thank you. Wendy Benjaminson down in Washington, D.C., a week away from that first debate for Republicans, hosted, of course, by Fox News. Lisa, how do you beat the former president if at the same time you are defending him, as Wendy put it?
This has been the question, and no one really has an answer, quite clearly, because nobody's really effectively taking a stance one way or another. The people who do go against him are losing popularity. The people who don't go against him are forced into a position where they're basically backing him, and he's their opponent. So how do you navigate this has been a real quagmire for them.
I heard from Vivek Ramaswamy over the weekend talking about that he would take counsel from the former president if he got into the White House. They're trying to walk this very, very tight line, aren't they? Basically saying that we support him, but at the same time, I'm a better candidate than him.
From a broader perspective, how have we priced this in? And I don't mean to just go back to markets because it's easier than talking about the
I don't know how you price any of this in.
But how do you sort of figure out where this is going when you have legally fraught candidates facing an election cycle at a time where we're worried about the debt, we're worried about geopolitical tensions? How do you then price in the potential for real unrest? I mean, honestly, I'm just thinking through what the ramifications could be going down, or is it all just white noise, as Dan Greenhouse says, until there's a catalyst?
Park the hyperbole. Let's go through the points that were made by Fitch in the last couple of weeks with the downgrade. One of them was a governance issue. If you've got worries about governance and institutional credibility in Washington, D.C., then there is a reason also to be concerned about the Treasury market as well.
Especially at a time where there does seem to be a lot of political potential turmoil. The people are starting to game out a little bit. We heard that from Lori Calvasina.
Trying to cut through the signal and the noise is almost impossible at times in Washington, and right now is one of those times. Equity futures right now on the S&P 500 negative by 0.5%.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
60 minutes away from US retail sales data. Going into that information, equities right now on the S&P 500 negative. We're down across the board, down by 0.5% on the S&P. On the Nasdaq, we're lower by 0.49%. Yesterday, best day for the Nasdaq 100 of the month so far. So we snapped back. We snapped back down this morning off the back of concerns all over again, over in China, and high yields in the mix as well. Let's turn to the bond market. The 10-year yield is higher once again by 3 basis points, 422.67. Let's call it 423. For those of you who don't follow this market too closely, this is a new high for 2023. The highs of the cycle go back to October. They're about 430-ish, just north of 430 intraday. But Lisa, we're getting closer and closer on a 10-year. And I would say I'd flag the 2-year too. Don't ignore what's happening at the front end. All this soft landing hopes and dreams and rate cuts early next year. Your 2-year, I think we can call that 5%, 497.56.
There's a story underpinning this, which is that the Fed is going to keep rates higher for longer, as seen in the 2-year yield going up and staying at a higher level, and that it's not going to bring inflation down meaningfully to get those yields in, or at least the term premium is going to be higher going forward for some other reasons. So you put that together. And what does that do to the rest of the risk complex? I don't know that people have fully appreciated that, but again, maybe it's all white noise.
We need to identify the dominant factor behind it, which right now is really difficult to do, I know. Is it the yield curve confusion over at the BOJ? Is it the additional supply? Is it something happening with the economic data? Take your pick. Is it the downgrade? I think most people shrug their shoulders at the downgrade, but ultimately, there's a ton going on at the same time, and it's hard to identify what is quite behind that move.
And you add to that this idea that you have the likes of J.P. Morgan, of Western Asset Management, of HSBC, reconfirming the buy duration kind of call, that yields will come back down. So where are they? If there are so many buyers out there, why haven't you seen the institutions step in a material way, especially in light of slowing global growth, especially in light of what we saw out of China?
Consensus view right now, without a doubt, on the Treasury market, it's difficult to sustain life above 4% on a US 10-year. We'll see. Right now at 423, and we've had 10 consecutive days of closing above 4% on a 10-year yield. Let's turn to the FX market. The euro at the moment, just a little stronger against the dollar at 109.34. Jordan Rochester of Nomura was on the program with us in the last hour. Jordan was talking at 116 by year end on the euro. He's thrown the towel in on that. Lisa, he's talking up the potential of maybe a drop to 105 on this disappointing data out of China, and plenty of reasons why the ECB have to do more, but also equally plenty of reasons why the ECB has to do less. A rock and a hard place for President Lagarde.
Kit Jukes actually put it really well. Why isn't the euro lower, right? The fact that we're seeing euro strength on a day like today, when the European economy is that much more linked to China, is a head scratcher. And there is a real question of whether the ECB is going to be able to hold rates where they are sooner, simply because there isn't the same kind of growth and inflation coming from China.
It's your top story today, under surveillance this morning. China's central bank unexpectedly cutting the rate on its 1-year loans by the most since 2020. Economic activity in the country, not great. The US Treasury Secretary Janet Yellen calling China's slowdown a, quote, risk factor for the US economy. I actually think that comment right there, Lisa, is quite interesting. How much of a risk factor is it? Dan Solis was on the program with us just a moment. Dan Greenhouse of Solis Alternative Asset Management, who loved that new name, Dan Solis. Dan Greenhouse was with us just moments ago. Dan said we'll be okay. That perhaps even, my words not his, but I'm paraphrasing here, US economy can decouple in a way that things get dicey in China doesn't mean things are bad here in the US.
Markets agree with him, and a lot of other people who've come on also agree with him, considering the fact that stocks have held in. We've known this for a while. This isn't new news. It's just the depth of how much the economy there is decelerating is perhaps a little bit deeper than people had expected, but we knew this. And the fact that yields are still higher in the US suggests that it's not going to materially diminish the inflation or growth projections that the US has. So again, are we dealing with decoupling, and is that part of what's underpinning some of the distortions that people are trying to explain in markets?
That's the top story in the global economy. I'd argue this is the top story down in Washington at the moment. Donald Trump indicted in Atlanta over efforts to overturn his 2020 election defeat in Georgia. It's the 4th criminal case brought against the former president. In a statement, Trump's lawyers calling the indictment, quote, shocking and absurd. And this is just going to dominate things, not just for the next year, but particularly the next week, Lisa, going into that first debate for Republicans?
And it is going to be highly politicized. And it's a very difficult one to talk about because there are people on both sides who either think that, you know, this is either a long time coming or this is just another evidence of the witch hunt that Donald Trump talks about. So you have both of those polls, and they're not getting closer to each other. And so how does this really shake out heading into a contentious election at a time where Donald Trump still is the front runner, still is the one who dominates really all of the races?
Let's finish on the earnings this morning. Home Depot beating estimates this morning, giving insight into the U.S. consumer. The company maintaining its fiscal 23 guidance, expecting comparable sales to decline as much as 5%. That's the story for them. The stock is down by about 0.2%. You'll hear from Target tomorrow, Walmart on Thursday, and in about 55 minutes from now, Lisa, we'll get that retail sales print for America.
How much are we going to learn from it? Are people going to look past it? How many times have we gotten an economic data print and people say, okay, but it's distorted because this, and this, but I still believe that X is going to happen? Haven't we seen that? It's data dependency with an asterisk, but we're depending on data that we haven't gotten yet. And I just feel like we're going to have that kind of discussion after this one, too.
Last big data point ahead of Jackson Hole.
Yeah.
Next week. This is kind of it for Chairman Powell. Is he delivering a speech? We had that confirmed yet?
I mean, I have not seen confirmation, but we're expecting him to deliver a speech. And what I want to understand is where they see the neutral rate now, where they see them going down to. I think the question now is not when they cut rates, is not whether they're going to raise rates another 25 basis points, but are they going to see a 3 to 3.5% kind of terminal Fed funds rate, and how that really changes the equation.
TK taking a bit of a break this morning to gear up for Jackson Hole coverage, live from Wyoming, about a week away. Joining us now, Blurina Ricci, Chief U.S. Economist at T. Rowe Price. Blurina, wonderful to catch up with you. Let's just talk about this. Just how resilient is this U.S. consumer?
Well, I think we're going to see some confirmation in the data, as you said, in 55 minutes, with the retail sales telling us how well did the consumer do during Amazon Prime Day, how strong is consumer spending on goods, which really has been the very surprising resilience of this year. We all expected goods consumption to decelerate and services to take over. What happened was that both services and goods has been strong. And I think that's related to the fact that the labor market in the U.S. has held up pretty well. Even though in the last couple of reports we've seen employment growth slowing, the unemployment rate is really very low. Aggregate incomes are growing, and we have inflation slowing, which is helping with real household disposable incomes as well. So when I'm looking at the next 3 to 6 months, I see some headwinds for the U.S. consumer for sure. Some of that is the fact that the excess savings buffer that was built during the pandemic is likely going to be depleted by year end. Some of it is to do with the resumption of student debt repayments later this year. But nevertheless, I think there is enough support from the labor market to prevent the U.S. consumer from completely rolling over. We also know that the debt part of the U.S. consumer, their balance sheet is fairly healthy. And even though credit card balances have increased in recent months, they're increasing from low levels. And we know that the U.S. consumer still has room to leverage in order to smooth consumption over the coming months.
We were talking earlier, Blurina, about sort of a rolling ball of money and this weird behavior after the pandemic where everyone just rushed out and had a you only live once kind of moment. They traveled, it was experiences. And then there was a question, okay, when will they be enough? They'll say enough with the airplanes, enough with traveling, and then they move somewhere else. Are we starting to see that? What else already? Are they starting to shift that allocation of their discretionary spending to another area?
So I think if you wanted to look for signs of some softness in the travel and hospitality sector, you could point to the recent softness or weakening in airfare prices. That could be a signal that demand there is not as strong as it used to be. But at this point in the business cycle, I don't think that there are many other areas where the consumer could go back and spend in force, especially because on big ticket items such as electronics and household items, they did spend already a lot during the pandemic. And we know we have a housing market that even though it's stabilized recently, it's weaker, and we're not seeing the same volume of homes being built and houses being sold. So that means that the pipeline of purchases of big ticket items and electronics should be lower as well.
Okay, so in other words, if you sort of put this all together, it sounds like the consumer is hanging in there, isn't going to necessarily stop spending. There might be a little bit less than the immediate sort of gangbuster spending post-pandemic, but we're looking at a scenario where that's not going to be what's going to break the economy, that can hold in. Is that what you're saying?
I think so. I think we need to be looking at what's going to cause the unemployment rate to increase. For that to happen, we need some firing to be in the pipeline in the private sector, in the corporate sector. And here I think interest rates and the discussion you're having earlier about what is neutral and how long will interest rates be restrictive is very important. We need to look at the corporate sector and their balance sheet and how long can they sustain debt servicing costs at these levels before profit margins really get squeezed. Because once that happens, that's going to be the time when they will not be able to hoard labor anymore. They'll start firing, and that's what's going to be the trigger for the U.S. households and the U.S. consumer to cave in.
Blarina, just quickly, Lisa and I were talking about the prospect of Chairman Powell speaking in Jackson Hole next week. It hasn't been confirmed yet, but most people expect it to happen. What would you expect to hear from him? What do you think the focus will be?
So I think he will probably recognize some of the progress that we've made on inflation to date. And in the last couple of reports, there were signs for optimism there, but at the same time, be very cautious not to declare victory. There are reasons to be concerned about how sustained this deceleration in inflation will be, because a lot of that has come from used car prices and airlines. Once those categories rebound, what's going to happen with the trend in inflation? And also, we're not getting an unequivocal weakness in inflation message, because the PCE measure has been stickier, and we expect the PCE numbers for July to be stronger than the CPI inflation data. So I think he'll be balanced and not rule out the fact that they may need to do another interest rate increase this year. I know that for some that's beyond the point, but I think this is very important because we are not certain that the last hike is behind us. So I think it's premature then for FOMC members to go out and already talk about cutting interest rates and how much and how soon we'll need to cut interest rates next year. So I think it will really come down to Powell to be on message, to be balanced about the progress done so far, but the work that is still ahead of us, and then leave it to the data to do the heavy lifting. Of course, if inflation decelerates much faster, then there might be room to ease monetary policy later in 2024, but it's too soon to start planning for that yet.
Blarina, I'll get your name out. Yurichi, thank you. T. Rowe Price, forgive me. The US data, more of that a little bit later this morning. Retail sales, less of that, more data a little bit later. US retail sales just around the corner. If you're just tuning in, welcome. Equity futures right now, negative by 0.7%. on the S&P 500. Coming up a little bit later, US retail sales. The focus of Citi, Bank of America, Lisa, they do believe that we can get another rate hike from this Federal Reserve. In the Jim Bianco camp, that maybe inflation starts to pick up again.
That's what we've seen in the data, right? I mean, honestly, people are looking at some of the core inflation. You start to see people talking about housing bottoming out, rents starting to pick back up in certain places. You start seeing all of these signs, and it points to that strength that Neil Dutta and Jim Bianco speak to. Other people say, just wait, that's going to come in.
I'm so pleased that TK wasn't there for that. Coming up, Lindsay Piegza, Chief Economist at Stifel.
He wouldn't have said her name. He would have just said...
No, he would have asked me to say it, and then I would have butchered it, and he would say, great, well done, John.
Yeah,
nice work.
Well, that would be on him.
TK, you missed.
You are missed.
Hopefully see him later this week. Jeff Yu of BNY Mellon coming up shortly. We'll talk to him about the FX market. Also some developments over in the United Kingdom. Record wage growth in the UK, just as people were hoping the Bank of England could back away and bring some life to the mortgage market for those of you looking to get on the housing market, the housing ladder. Maybe the BOE comes back for more.
7.8% wage growth. That's without bonuses. That is shocking compared to the expectation of 7.4%.
Fantastic if you're receiving it. You know, it's shocking if your goal is to get them down because you're worried about inflation.
They just stop asking for wage increases.
Yeah, that's a great message to send to the British public, and one that apparently isn't working either. From New York, this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
The administration remains committed to taking actions to lower prices for Americans where we can. And we continue to monitor developments, particularly those abroad, that may affect prices and growth.
Secretary Yellen, the Treasury Secretary, speaking in Las Vegas with local union workers, also mentioning, of course, Lisa, on China being a risk factor for the U.S. economy. The data out of China, not great overnight.
So here's the sort of two poles of the discussion where people are saying the U.S. is decoupling from China and doesn't need to necessarily worry too much about the slowdown there. And other people saying that's just not true, that these are two economies intricately connected to one another. If that's the case, are we not pricing in that potential slowdown?
Well, I think we've got to be consistent. If you were super looking forward to and excited about the reopening, lifting U.S. equity markets, which is some commentary we've received this morning, then you also have to believe simultaneously that if it doesn't impress, then that's a reason not to like U.S. equity markets. The multinationals, they make up a big slice of the S&P 500. If we're talking about a slowdown in Europe, a slowdown in China, and an inability to respond to it, then it's going to affect some companies more than others.
And I'm thinking about Apple, for example, in terms of manufacturing. I'm thinking about Tesla. We saw that with the price cuts in order to compete more effectively. And then the big industrials as well, Caterpillar, others. And they've talked about this. They're ratcheting down their sales expectations in China.
Equities right now negative. This session lows, actually. We're down by 0.7% on the S&P 500. Yields are higher by 3 basis points. 422.28. Talked a lot about the economic data still to come. U.S. retail sales a little bit later in the next hour, 8:30 Eastern Time. Jeff Yu joins us now, Senior Market Strategist at BNY Mellon. Jeff, wonderful to get you on the program with us, particularly from the UK. So we can start in London with some record wage growth. Jeff, just how tight is this labour market and how supply constrained is it going forward from here?
I don't think things are going to get easier anytime soon. I mean, it's not just the one-offs people are talking about. If you look at the job creation over the last 3 months or so, these are very, very strong gains. What's interesting is some of the services sectors in terms of outright job creation and wage growth, the openings of growth, that has softened, but other areas of the economy still going strong. So Governor Bailey, he's going to watch his language very carefully, of course, in terms of not asking for wage increases, but I think the economy is moving on right now.
Jeff, in the US, we're talking about things like soft landings, getting inflation down towards 2% without a recession. Do you think Governor Bailey and the Bank of England has that luxury? Can they get inflation back towards target without a recession?
I don't think they're going to have to commit to anything at this point. My view is the last meeting they should have done 50 basis points. So you front load all the easing right now. And to be frank, I know it's a bit of with the benefit of hindsight, but today's data actually does justify that. I think they're going to have to keep going at 25 increments, until we get a clear glide path. But that's potentially 12 to 18 months away.
How different is the situation in the UK, where you are foreseeing future rate hikes, and the ECB at a time when some people are gaming at the end of the rate hikes over there, especially in light of what we're seeing with China?
The centrist speech from Madame Lagarde, and she mentioned something about the Eurozone economy and the labour market, but I think you can apply that to the UK as well. In extremis, it's basically you are seeing a lot of wage growth, but from the non-productive sectors. The UK is a productivity puzzle. So you really get kind of that stagflationary growth in the UK, and it's not going to help anytime soon. Now, with the Eurozone, they are going to be worried about China. Manufacturing PMIs, they're going to continue to print awful, probably below 40. So that probably has a bit more of a disinflationary drag on the Eurozone economy. So I think the Eurozone can get to a soft landing, but they're going to have to look closely at the manufacturing sector, not just in the short term, but with all the EV technology coming through, the medium to longer term as well. Eurozone has to restructure.
Hold on a second. This is actually really important, Jeff, because we've been hearing from the likes of Kit Jukes, who says that he's surprised the euro isn't weaker. A lot of people are asking the same question. You're saying that actually the disinflation from China could enable the soft landing in Europe that a lot of people thought was looking less likely than in the US. Is that correct?
I do think so, right? Because what you have is, with manufacturing jobs, these are high value-added jobs which are being lost right now. The multiplier effect comes through. In time, you're going to see high value-added jobs decline, and that will affect growth in the services side. Because those who can spend, if they can't spend anymore, then I think services demand will come off as well. So that glide path is in place, and trend growth is lower in the Eurozone as well. But that's just in the short term. In the medium to longer term, once we get inflation back to target, where is the Eurozone growth strategy from here? Especially with the onslaught of EV into Europe from China. I think that is a 5, 10, 25-year conversation that needs to be had in Europe right now.
Jeff, let's talk about the growth strategy out of China. I've shared some commentary a few times this morning from Standard Chartered. They called the cut from the central bank aggressive, from SocGen unlikely to be the last measure. Jeff, most people assume this was insufficient. If there's more to come, what is there to come?
Shall we have a conversation about quantitative easing by the People's Bank of China, right? And we're talking large volumes here. What if you do get quantitative easing out of China to the extent that it can start to offset some of the balance sheet contraction, the QT in the Fed and ECB, right? That changes global liquidity dynamics materially. There are legal constraints around this, I think, but if we go towards the end of last year, the PBOC did fully subscribe to a bond rollover, 750 billion renminbi at that point. It is doable. It doesn't have to be a planned program. So I'm not saying that is not my base case, just to be clear, but all options need to be on the table right now. Fiscal in concert with monetary, that comprehensive approach is needed from China right now. It's already getting quite late in the year, even in the fiscal year, so we do expect more, but the later they put in terms of policy, probably the stronger it's going to have to be.
Jeff, do you believe things are that bad at the moment over there?
Well, if you just look at the loan figures, right, and I do know if you go back to the previous premier Li Keqiang, there was a Li Keqiang index, right? It is available on Bloomberg, and he looked at short-term indicators, and loan growth was part of that. Power generation, freight, everything put together. You're not seeing the seasonal recovery that we anticipated in the past. So the thing is, do you want to wait until things are that bad and then find out it's too late? Because you're always going to have to play catch-up. So going back to my earlier point, right now it's already quite late in the year. You need to front load the stimulus in the same way the BOE needs to front load or needed to front load a bit of their rate hikes.
Jeff, a lot of people are saying that the fact that the Communist Party has not done more indicates a lack of willingness to go as far as you were talking about with some sort of massive quantitative easing program. Do you agree, or do you think that it's premature to write off something more substantial?
So I think any QE program, from the PBOC or anything along those lines, I think it's very easy to draw an equivalence with what happened in 2009, the big loan program. That is very, very different. So the transmission of QE, the central bank buys government bonds, and then you lower real rates. China needs to lower real rates, right now. So I think that's why they're allowing, within reason, the renminbi to depreciate, because that imports some inflation. So it's so yes, the Ministry of Finance is worried about and the PBOC about a debt issue building up 5 5 to 10 years from now, but they need to do something that is different to 2009 and in size to basically lift sentiment targeting the consumer. They've absolutely said the right things over the past month or so, but now really is to put everything in effect, focus on real rates. They need to do whatever it takes to get those things down.
Hey, Jeff, thank you. Jeff Yu there of BNY Mellon. Quite a moment today. Dollar CNH through 730. At least on that currency pair. Weaker Chinese currency off the back of these rate cuts and some difficult economic data out of the world's second largest economy.
And Jeff saying that that's okay with them because it might import some inflation. Again, this just sort of points to how strange this moment is with such a fracturing of the major global economies, with the U.S. and Europe fighting inflation and China facing deflation or disinflation in a massive way. This is a real concern, given that this was an engine of growth for so many years.
Well, at least complementary in one way, because the United States would like to import some disinflation too, right? So it works both ways.
It does work both ways. But I think that you asked the right question, John, which is how divorced is the U.S. economy truly from China? Where is the interconnectedness, not only of Europe and China, but also the U.S.? And I don't think we fully understand that.
Well, there's two ways of framing that question, and you only have to change a couple of words for it to have a very different meaning, a different answer. How divorced is the U.S. economy? How divorced are U.S. markets? Because that's a very different question in many ways. You can make the argument we're less dependent on U.S. imports of Chinese goods. We can see that in the data, but is the market, the equity market, the benchmark, the weightings of some of these multinationals less exposed to what's happening in Europe, in China, and worldwide?
And if you think about the real estate market, how many Chinese investors came into U.S. real estate to buy up buildings that may not be there quite to the same degree? There is this question of how much is that part of what's underpinning some of the move in yields, the lack of Chinese, the lack of Japanese buyers.
The conversation continues with Bob Dole of Crossmark. He joins us in the studio in about 5 minutes' time. From New York City, this is Bloomberg.
Well, welcome back to another special Western and Southern Open update for Bloomberg TV and Radio from Tennis Channel. I'm Erin Coscarelli. 43-year-old Venus Williams turned back the clock as she took out 16th seed Veronika Kudermetova on day one in Cincinnati. The seven-time major champion's last win over a top 20 opponent was Kiki Bertens back in 2019. And don't forget, you can watch all the action live at 11 a.m. Eastern on Tennis Channel.
Forget a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store. so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
What I think we're missing in order to get bigger trends is a bit of global divergence.
The longer the imbalances persist, the worse the recession will be.
I do think to some degree we're out of the zero rate environment that we have been.
To me, the risk to inflation is 3-6 months, it starts peaking back up.
What we really need in order for some of the slowdown to materialize is to see monetary policy that's somewhat a little more restrictive.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Retail sales in America 30 minutes away. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market on the S&P 500 right now, session lows, down by 0.7%. More weak data out of China, a rate cut from the Chinese central bank in the mix. Insufficient to put a floor under risk sentiment, risk appetite worldwide at the moment. There is a real concern about what's developing, Lisa, in the world's second largest economy, and an inability maybe for the Chinese policymaker at this point to do anything about it.
Inability or unwillingness, right? And that's sort of the key question that a lot of people have. The fact that there hasn't been a greater noise or a greater move to date, or move that would actually comprehensively target the source of the weakness, which is consumers aren't spending and the housing market needs to be corrected, has left people thinking that maybe it's just not going to come this time.
Equity session lows. Bond yields near session highs. Stateside, our focus shifts. 29 minutes away from retail sales in America. It's all about the U.S. consumer this week. And this is against the backdrop where treasuries are selling off, yields are higher. The Federal Reserve is engaging in this happy talk about a soft landing and maybe even rate cuts next year. And here we are with the long end of the treasury market selling off over the last month.
The highest of the year, going back potentially to before the pandemic, before the financial crisis. If you take a look, just a couple more basis points away from the high in this particular cycle. We're looking at a time where people are resetting and saying the Fed's going to hold rates longer, higher for longer, because there has been this resilience. And that subtle shift of not cutting rates next year as quickly as they previously thought is a game changer for investment theses that's just starting to work its way out in terms of what we're seeing in the prices.
Let's go through the calendar together. So today, retail sales in about 28 minutes. Tomorrow, earnings from Target. Then on to Thursday, numbers from Walmart. And Lisa, in between, we get the Federal Reserve minutes. The Fed minutes, is that a platform for the hawks, for the doves? What's the balance of risks around doing too much, doing too little? That's clearly shifted in the last 12 months since the last Jackson Hole meeting.
I couldn't agree more. There's a feeling of leaning into the hope of a soft landing, not wanting to disrupt it, of the hold. And why not hold rates and just wait? What are they waiting for? And this is really the question that we have to ask, which is how long do they have before they miss the boat in terms of being sufficiently restrictive or easing, right? Where is the balance of risks in terms of where inflation goes if it reaccelerates or if it's going to come down really dramatically?
In other words, is there a window to deal with this before it becomes embedded? Do you have to tackle with it more quickly?
Well said.
Well, I'm just trying to build on it. And I'm thinking at the same time as I'm saying it, I'm thinking of the UK, because wage growth in the UK today, just phenomenal. Record wage growth. What was it, a 7 handle?
7.8%, yeah.
It's amazing. We're talking about the Bank of England backing away, and they've got wage growth of 7+% in the United Kingdom.
But it's well said about embedded and the sort of odd confluence of things. Yesterday, the New York Fed put out their inflation expectations survey, and it actually showed them coming down. So on one hand, and you saw it in the University of Michigan sentiment survey as well, inflation expectations are contained for now. But if people keep getting wage increases, if they keep spending, if they keep seeing the strength, at what point does it normalize some of the price instability that we've gotten used to?
They'll tell the University of Michigan all about it, and you'll see it in their survey.
You could too, if you got called.
You could too, if you get the call. I want the call. Equities right now on the S&P, deeply negative by 0.75%. We're near session lows here on the S&P 500. In the bond market, yields are higher by 4 basis points. Talked a lot about that 423 level. Crude backing away. Against the grain of the last month or so, though, Lisa, crude still above 80, 81.39. We're down here by a little more than 1%.
And a risk factor, considering the fact that that was one of the tailwinds for certainly the European region, but also the U.S. Is there the ammunition to fight it? Crude, to me, is one of the big stories, especially because how many people have come on and said that's the story they're leaning into? They're buying energy stocks. That's the sector that's going to do well. Can it continue to do well with China in the situation that it is? And then what does that mean for inflation?
The crude's in the 80s. We're talking about a growth slowdown and rate cuts in China.
And how much is this just supply? The fact that Saudi Arabia is cutting versus everyone's still flying around. Everyone's still, going around their Hummer.
Their Hummer.
Yeah,
Hummer.
even, maybe it's electric, but, either
They're
way.
expensive. They
Hummers?
Are. Yeah.
Have you looked into one?
No, the EV version of it is expensive.
Yeah,
they cost a lot of money.
Well, so does the non-EV.
Well, they cost a lot of money to run. Yeah. I know.
All of it.
Bob
all
Dole's
the
with
above.
us now. Wants to talk about markets, CIO of Crossmark Global Investments. Bob, good morning to you.
Same.
Let's talk about retail sales, 25 minutes away. Are we going to see that resilience in this U.S. economy, this U.S. consumer, in the data we're set to see in this hour?
You just put a lot of good things, the two of you, on the table. A soft landing is like putting a thread into the needle, and the eye of that needle is shrinking. It's getting tougher and tougher. The consumer eventually will come to their knees. We always see it at the low end. We see it with credit extension. We see it. Wage growth is strong. How long will it stay strong? And that has just fueled the consumer, and it's fueled our economy, and this thing is kept on going. Despite all the things in the background that you just put on the table, including the lagged effects of the Fed going from 0 to 5.25. We have not felt all of that yet.
Let's unpack that. It will happen eventually. Are we seeing signs of it now? You mentioned credit. You can see it through credit, maybe one way. Another way might be to see it in the official data. We'll see that at the bottom of the hour, 8:30. Another way might be the earnings. Across those three things right now, credit, data, earnings, are you seeing a slowdown?
Not really. It's all lead indicators. The coincident indicators are positive. Some of them are getting a little mixed. It's going to take some more time to go there. We've been, since the first of the year, saying recession starts sometimes between Labor Day and the end of the year. Still sticking with that. Think it's a mild recession, as many do, although recessions left most people's vocabulary, as you know.
But where does that recession come from if you do see the strength in consumers? And a lot of people have pointed to the student loan issue. And I was reading this article, this survey by Credit Karma, and it was showing that 45% of student loan borrowers say that they are not going to repay. They're basically going to be delinquent for 12 months because they're not going to get penalized for being delinquent for 12 months. So aren't we basically getting a self-stimulus ongoing that will remain in place for a while?
Well, it's been the story, and it's lasted a little longer than many people thought, and it's still not finished. But eventually consumers will come to the realization that things are a lot more expensive. Inflation's still a problem. They have no savings at the lower end of the consumer bracket, and that's a problem. And they're going to have to retrench some or find a second job, and they've already done that.
What's the hedge? What's the defensive play at a time when a lot of the strongest companies have incredibly high multiples, and you're looking at bond yields that are not giving a consistent message?
Yeah, I think that within the equity market, you try to focus on companies that have high earnings predictability, high earnings persistence, and are not selling at crazy prices. And that's not a whole lot of places. I like the HMOs, for example. I've not given up on tech, but I want to be careful what PE I'm paying for my tech. So some of the semiconductor stocks, some of the software stocks, they're not so cheap. Visa and MasterCard, two names I still like. They've gotten more expensive. So you have to pick your spots, and I come back to earnings, persistence, and cash flow generation.
Let's talk about the retailers then. Home Depot out this morning, Walmart later this week, Thursday, Target tomorrow. Have they still got that pricing power? Can they keep margins pretty steady, or do those margins get eaten away at?
Eventually, and I think we'll see some of that, like now, those margins get eaten away. Because you see, companies can only raise prices so far, and you're already seeing consumers begin to make noise and balk and stop buying some things. It won't be everything, but slowly but surely you take the edge off. We have to operate on 8 cylinders to keep the thing where it is now. And even if we back off to 6, that's going to disappoint a lot of people with stock selling where they are. Well,
let's highlight the winners. Forget tech. Cruise lines, airlines. Are we at that point where we've reached consumer price intolerance? They just don't want to pay it anymore.
Well, as you said a minute ago, people are flying around. We go on an airplane and, every seat's taken. So we're not there yet, but we'll get there.
Okay, so what's going to get us there? Because everyone's been saying this, that the consumer eventually will push back. And then they haven't. And then you go out to eat and it costs twice what it used to. I mean, honestly, this is the kind of increases that you're seeing.
Yeah, so it was subtle. We had 15 months in a row of better than expected monthly employment numbers. The last 2 months have been below expectations. So there are cracks beginning to develop. I don't want to come across as the economy's tanking and want to be a bear overall. I'm just cautious. And I add to it, I said already, I'll say it again. If the PE were 14, different story. But, at the peak a couple of weeks ago, I looked at my screen on trailing earnings, 23 times earnings.
When you talk about being cautious, what's the ballast? If you talked about your equities, is it cash? Is it going into duration?
I think having some cash in your portfolio when it yields 5% is not a stupid idea.
Have you been increasing it?
In the balanced accounts where we can, in the equity market neutral portfolios, we've been bringing our equity exposure down and therefore our cash exposure up, yes. Bonds, own some bonds. I'm not sure that we've seen the high-end yields yet, but I'd rather begin to nibble at 4.25 than 3.5, where we were not that long ago.
Well, you think start to go out along the curve, start locking some of this stuff in?
Slowly but surely, yes.
I heard the same thing from Lisa Shallett over at Morgan Stanley. You think we face that reinvestment risk, rate cuts on the horizon?
That will happen at some point, so I don't want all my eggs in the short-term 5% basket. Look, a year ago, 18 months ago, 1.5% 10-year Treasury. That was a bad deal. 4.25, I think I'll think about it.
It's unthinkable, isn't it? It wasn't that long ago.
No.
It wasn't that long ago.
And it happened fast.
I know, it really did, Bob. It's happening fast now. Bob, it's good to see you. Thank you, sir. Thank you. Bob Dole of Crossmark Global Investments. This sell-off's happened quickly. The last month in the Treasury market, we thought we'd seen the highs back in October. That was it, 430. I think there was a feeling we'd seen the post-SVB failure highs of 420. And here we are doing it all over again in the last month.
You know what makes me a little sad?
What's that?
That you can't buy the actual bond and get the certificate and then, show your kids and say, this is a bond, and when it comes due, you get this amount.
Is that what you'd like to do?
Well, kind of. I don't know, my grandfather did that. And I remember when they came due, and we kind of have gotten away from that. And,
are the Bramo kids learning about bonds already? They're doing fixed income?
They've been learning about it since, kindergarten.
Since they're 8?
Oh, yeah. Oh, yeah, before that. We had lots of discussions.
Really?
We have really fun,
Oh, it sounds so fun. It's so fun. If you're just tuning in, welcome. On the S&P 500 right now, negative 0.7%. Summer at Casa Bramo. Can you imagine? Can you imagine?
Okay, true story. My son is actually taking a finance class this week.
Well, he wants to invest, right?
Yeah, he's really interested in that.
Are you letting him invest?
Well, it's very tricky because I don't want there to be conflict of interest, so I want him to do it virtually.
Well, he doesn't have to tell you what he's investing in. He can talk about broad asset classes.
But he's actually he said to me last night, he's like, Mom, I'm learning about this, and I think the Fed should just hold. I'm like, oh, no, I'm not having this at home.
And how old's this one?
He's 14.
14 with a view on the Fed.
Well, he thought it was really interesting. It is interesting. I mean, this is what everybody's talking about.
Did you tell him he's very consensus? Did you tell him that?
Yes.
He might be upset about that.
I told him, I said, the extremes on either side, and I was starting to explain it, and then I went to sleep instead.
Oh, right. And you can teach him about QE and why they killed capitalism and all of that at a later date.
Basically, you don't want to be my child. That's essentially what you're learning today, and that my household is incredibly nerdy.
That sounds great. 8:30, so 17 minutes away, resale sales data in America. Lindsay Piegza of Stifel is going to join us to break down some of that data going into Jackson Hole next week. It's only a week or so away. Most people expecting Chairman Powell to say something about something. We just don't know what that something is. We're expecting him to talk, Bramo.
I guess we're expecting him to talk, and a lot of people are saying that the best case scenario for him is just to say as little as possible.
I agree. I'm so on that page.
I mean,
you start entertaining rate cuts because you want to keep real rates steady and you don't want policy to get too restrictive. You send a signal doing that. That sends a signal.
If he leans into the market action, saying the market has it about right that we're not going to cut rates, that could actually have an impact on risk assets.
Okay. Jackson Hole,
we're going to
a
be
week
there,
away.
so
We'll be there. Terry Haynes of Pangaea up next.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
The indictment alleges that rather than abide by Georgia's legal process for election challenges, the defendants engaged in a criminal racketeering enterprise to overturn Georgia's presidential election result. I am giving the defendants the opportunity to voluntarily surrender no later than noon on Friday, the 25th day of August, 2023.
It's about a week away, 10 days away. That was Fani Willis there, the District Attorney of Fulton County, Georgia, laying out the indictment against the former President Donald Trump and 18 others over efforts to overturn the results of the 2020 presidential election in the state. In a statement, Trump's attorneys calling the charges both shocking and absurd. Lisa, make it number 4.
Yeah, and at a time when people are wondering how this will play into the election, just to note, this could be the first trial to be televised, and that's important at a time when televised events have benefited Donald Trump in the polls. Typically, we've been talking about how press is often good in terms of facial recognition, and whether that will continue will be an interesting question.
I think we can all agree on one thing: it's in the public interest to see some of this.
And in Georgia, they have a rule allowing televisation of some of these court cases. So people are speculating this may be the first to really be aired in real time.
Watch this space. Watch this space. We've had some great guests this morning already. Bob Dole of Crossmark just moments ago. On the way out the studio, he said this. He left us with this. And he said I could share it with you, so I will. He said 4,200 before 4,600 on the S&P 500, 4,200 before 4,600. Right now, equities are weaker. Let's whip through the price action together. We're about 12 minutes away from retail sales in America. Equity futures are negative by 0.65%, just about off session lows. A lot of attention on the bond market for good reason. The sell-off continues. Treasuries down, yields higher by 4 basis points. Lisa, it's 423 on a 10-year.
This, to me, is the story of the past few weeks, the grind higher and what's behind it. And you ask 5 people, you will get 5 different answers. But the bottom line is, for all the people who say they're leading into duration, it isn't affecting the duration in terms of price and yield.
Lock it in. Bob talked about locking it in. I saw the same in a note from Lisa Shallett over at Morgan Stanley as well. The reinvestment risk of, sure, that 1-year T-bill, whatever it might be, feels good right now. But what if that matures and they're cutting rates and you've missed the opportunity to lock some of this in?
We've heard that from Morgan Stanley. We've heard that from JP Morgan.
Yeah.
We've heard that from Western Asset Management. We've heard that from a whole host of others, including HSBC this morning. Again, we hear this. Where are the mass buyers? You know, when they step in, then yields will come in. Not yet.
Retail sales, 11 minutes away. Joining us now on Washington and the latest developments down in Georgia, Terry Haynes, founder of Pangea Policy. Terry, wonderful to catch up with you, sir. Always thoughtful, our conversations together. We mentioned this in the last couple of hours, and I think it's the appropriate place to start. We've got cases now in New York, in Washington, D.C., in Florida, in Georgia. Terry, how do you rank those, just in terms of importance?
Oh, importance? I think it's far too early to tell for one reason that you and Lisa were just talking about, which is the timing of the cases. You know, there's a lot of different ways you can slice these things: federal versus state, racketeering versus conspirators, all kinds of things. I'd rank them in order of how they're actually going to come to trial, and to some extent, and to some extent, it matters greatly, you know, frankly, I think whether they're televised or not, as you say. I mean, the closer people see what's actually going on and why, they're going to have more of an opportunity to make up their minds on it.
Terry, can you elaborate a little bit? Why is the television of this important? You said to make up their minds, but what do you think the outcome will be of having it very much in the public eye?
I think there's just an immediacy to television, frankly. And, you know, I think we've seen that over the past 60, 70 years, just in terms of how people perceive candidates and people choose candidates. So, you know, very broadly, there's that. But secondly, there is a debate, more than a debate in the country, about whether this is politicized prosecution or whether there's something here. So there's going to be an awful lot of pressure on the Fulton County DA to show that these charges are real and they're not the kind of standard splash that prosecutors do. You know, prosecutors tend to go in front of grand juries, particularly. You go big, you go broad, you get the maximum you can from the grand jury. In this case, it's going to be, you know, did she overstep? Does she actually have evidence? And, you know, and of course, the other side has a great deal to say about how to interpret the evidence. So, you know, this is going to be on a pretty big stage, and even more so if it's the first one.
Terry, there's a real question around the different poles of the political sphere right now and how people are going to respond to court cases that most of America or many of Americans have already decided about, regardless of what's happened yet. What do you think the outcome will be to some sort of conclusion of the trial if there is some sort of conviction? I mean, I'm just trying to play out the political risks here on a social level.
Well, I think firstly, and I've said this to you all before, I think there is greater uncertainty around the 2024 presidential election because you have increased risk for an uncertainty about Trump and about Biden. On Trump specifically, I think what you've got is a situation where, you know, if there's a conviction, my instinct is what happens is that it accelerates this death by 1,000 paper cuts process where people say, you know what, regardless of Trump policies, regardless of whatever, you know, movement, you know, kind of anti-establishment movement I think exists here, I'd be better off with another candidate. So I tend to think the more the prosecutions start landing home, the more that the Republican electorate turns elsewhere.
Right now, Terry, as you game out that political risk and you talk to different clients, what are you telling them to prepare for? What is the way that it will manifest itself if we're not focused as much on, say, debt reduction or some of the tangibles, nuts and bolts of fiscal governance?
Well, I say a couple of things. One is that the first action in the presidential primary process is 5 months, I think, from today. I mean, you know, Iowa, I think, is 5 months from today. So that's a very long time in politics, and there are examples all over the board about how somebody that was leading in the polls today, didn't win different primary challenges. So, number one, there's that. Number two, keep your eye on the panoply of things that are going on in Washington. Not just the Trump matter or the Biden matter. You've got, just in the next few months, you've got I think a shutdown likelihood, a government shutdown likelihood at 60%. You've got probably no meaningful action on debt and fiscal, which markets are increasingly interested in. You've got everything from the China economy to the Ukraine-Russia matter to think about, bank capital standards, and all the way down to John's favorite topic, UFOs. So, what we've got is a situation here where there's an awful lot of risk coming out of Washington on a variety of fronts all at once, and it behooves investors to pay attention to all of it, not just this particular bread and circus.
Terry, how did you know that? How did you know that? Terry, how real is this down in D.C. when you watch these hearings? How real is it?
Which part? The UFO
UFOs,
part?
Obviously, Terry.
The cheap and easy line is to say anybody that watches Washington with regularity, does believe in, that there's something out there that, is affecting things that isn't us. I think there's an awful lot of circumstantial evidence on the UFO matter, as there always has been. And, they're going to need to get to the next step to start convincing people.
Terry, thank you, sir. Terry Haynes of Pangea Policy down in Washington. It's fascinating to watch.
Everybody knows that you love UFOs.
I probably said it. Probably said it on air.
Did you see that Paul Krugman?
I mean, love is strong. Love is strong.
But you care about them, and you believe in them.
Increasingly aware and interested in.
Well, I will just say this. On Odd Lots of Bloomberg, Paul Krugman was on there talking about UFOs.
What did he say?
He said that alien invasions are inflationary.
Okay.
So
we can expect them to be deflationary, right?
Wow, that's harsh.
Isn't that what we do? I thought that was the game. Krugman says, and you no. Okay.
He actually just wrote a column about how he is talking about how he's gotten things wrong. Look, all I can say is, the fact that we're talking about UFOs more than debt reduction.
Well, we're not. When we just did, indulge me. We just did 60 seconds. That's all.
And actually, people do see unidentified flying objects a lot.
Yeah, I know.
But do you actually think they're like little green creatures inside, big like, ooh?
No one said anything about that.
Okay.
Did I make noises? No, I didn't. Retail sales, 5 minutes away from New York. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
US retail sales, that data, seconds away. Going into it, the scores look like this on the S&P 500. Equity futures near session lows and down about 0.6%. In the bond market, 10 seconds ahead of the data, Treasuries selling off once again. Yields are higher on a 10-year by 3 or 4 basis points. 4.23 is the yield on a US 10-year at the moment. We're at a new high for 2023. The economic data in America just about to drop across the Bloomberg. We'll do this 3 different ways. Let's start with the headline number. Retail sales upside surprise.
Wow.
Across the board here, 0.7% against an estimate of 0.4. You can strip out autos, you can strip out gas. The numbers look like this. Positive 1%. The survey, positive 0.4. If you look at the control group, that number, of course, goes into GDP. That is an upside surprise as well at 1%. The estimate there, 0.5. So it's an upside surprise across the board here for US retail sales. In the bond market, guess what is happening? Yields are up here by 7 basis points on a 10-year to 4.26, getting very close to a cycle high for a 10-year yield. In the equity market, breaking down towards session lows, we're down by 0.7%. Lisa, that's an upside surprise.
Again, at a time when people were expecting there to be a little bit of bite with people not necessarily having the savings. We're looking right now. I'm just watching that 2-year yield climb past 5%. We're now gaming out a 5% yield for 2 years. And the length of that is really what's catching my attention over in the currency space. Well, that euro strength fades, and we can see a 1089. We actually broke out of the 109 version as dollar really does become ascendant.
If you bring up an intraday chart of the euro on your screen at home, just take a look. It's literally just like that, down bank. The euro negative on the session now. It was positive, a break of 109 briefly, but that's upside surprise again for US retail sales, and that goes in. This is the last big data point before Jackson Hole next week, Lisa. The consumer, based on retail sales, I know we can break down what's happening beneath the surface, still looking pretty resilient. Inflation, some people still arguing, is bottoming here and may well pick up through the year. And this bond market is not smelling the end of a rate hiking cycle of the 2 years back through 5%, is it?
No, and if it is seeing the end of the actual hiking cycle, it's seeing the the constancy of a rate that's held at that level, not necessarily rate cuts. It's not just the upside surprise, it's the nature of the upside surprise. The control group, which you pointed to, John, which does go into GDP, came in at 1% month over month versus the estimate of 0.5%, up from 0.5% the prior month, which was revised lower by 0.1%. This is a massive upside surprise, especially on month over month at a time when consumers were supposed to be running out of gas in their tank.
So let me go through this again. If you are just tuning in, upside surprise, 0.7%. Headline retail sales for the month of July. That's month over month. The number we were looking for in the survey, 0.4. Strip out autos and gas, that number is 1% against an estimate of 0.4. And the control group, the so-called control group, that's the number that goes into GDP, 1% against an estimate of 0.5. Equities still lower, treasuries lower too, yields elevated right the way through the curve. As Lisa mentioned, the 2-year through 5%, the 10-year at 4.26. In the FX market, a stronger dollar dollar, a weaker euro. Euro dollar right now 109. Coming up on the program in the next hour to break this down, Amanda Lynham of BlackRock, Michael Kushmer of Morgan Stanley, Tony Dwyer of Canaccord Genuity. Lisa, all of that still to come on Bloomberg TV.
Fascinating conversations at a time where it does seem like everyone's looking at the potential for some sort of sea change, some sort of shift, and it happens to be in the wrong direction, at least for the bond market and equity market. As we work through some of these numbers, you have to wonder at what point does the consumer stop fueling an economic recovery that has lasted longer and been more robust than almost anyone had expected. Lindsay Piegza, someone who's been calling for rates to be much higher, potentially even with a 6 handle for the Federal Reserve to get inflation under control, joins us right now. She is a chief economist at Stifel. Lindsay, what's your view on why we saw such a big upside surprise on retail sales?
Well, this certainly was a stronger than expected report, and no doubt this will boost optimism that because of the resilience of the consumer, we can achieve that soft landing. But I would push back a little bit in the sense that we don't need to put too much focus on 1 month's numbers. What we have seen is a tremendous amount of volatility in terms of consumer activity month to month, suggesting that, yes, while this was a welcome step in the right direction, consumers are increasingly shifting the goods and services in their basket on a month-to-month basis, something that they do, something we do as consumers when we are increasingly concerned about our financial footing. So while this is, again, beating the expectations for the market, I wouldn't necessarily say that this is a trend that can continue to rise, particularly against the backdrop of some of these factors that prove artificial support, drawing down savings, a last sputtering of state and local stimulus. We see hardship withdrawals from 401ks up over 40% on a year-over-year basis. But while this will provide a temporary support, this is not an indefinite support to the consumer.
So where does this fit in, Lindsay, to your view that you previously had, that the Fed had a lot more work to do and that they had to get to a level that nobody was gaming out, or very few, of 6% or north of that?
Well, I think this is going to make the Fed's job more difficult, because the longer it takes for the labor market, for the consumer to show that needed weakness or respond to earlier policy tightening, the more aggressive the response from the Fed must be, thus ensuring an eventual downturn. So the notion that the fact that consumer has continued to be resilient across the first 525 basis points, supporting the notion of a soft landing, no, I would argue it's quite the opposite. That simply means the Fed will have to be more aggressive, raising rates higher and keeping rates higher for longer than investors had anticipated, suggesting that the downturn potentially and eventually will come and may be more aggressive, more of a downturn than previously anticipated if the Fed didn't need to raise rates quite as much to squash out inflation.
Lindsay, you said two things: raise rates higher and keep them there for longer. And those were the ideas that people had. But some people are starting to think, okay, what if the Fed is done with how high they're going to raise rates, but they are going to keep them there for longer? And that's what we're seeing priced into the market gradually, with some of the highest longer-term expectations for Fed funds rates that we've seen in this cycle. At what point does that cause more damage in your view?
Well, I think it's certainly going to cause more damage. Again, the more pressure on the Fed to respond. Now, if we continue to see this type of resilience, if we continue to see third quarter GDP surpass earlier expectations or surpass what we saw in the second quarter, I think the Fed doesn't necessarily need to continue to raise rates indefinitely. But once they reach that sufficiently restrictive level, as you mentioned, we've long conceded that will be 6% or above, the Fed is likely going to be forced to keep us at that elevated level for some time. The Fed itself has said rate cuts are not in their base case scenario for 2023, but even 2024 remains a sizable question mark if we aren't able to see that intended result. Remember, the Fed is raising rates to tap down consumption, tap down investment, and result in a slower level of activity in order to get that more benign inflation. But thus far, the economy is pushing very hard against the intentions of tighter monetary policy.
If you are just joining us, we are just seeing the ramifications of retail sales numbers that came in significantly higher than expected. We're seeing the overall month-over-month headline number of 0.7% versus expectations of 0.4%. The control group, which does factor into the U.S. gross domestic product figure came in at 1% from the expected 0.5%. We are seeing 2-year yields surge past 5%, 10-year yields and 30-year yields both reaching the highest level since October, climbing up. We're seeing 30-year yields 4.32%. Lindsay Piegza of Stifel with us. And Lindsay, I really want to get your sense of what could potentially halt this spending. You were saying it can't persist. You're not going to see this forever. Some people have pointed to the student loan repayments that are going to restart in October. Do you give credence to this sort of idea that we could see some sort of tightening and fiscal tightening on that front going forward?
Oh, absolutely. There's a number of factors. And remember, even with this monthly increase, beating expectations, when we take a step back and look at the longer term momentum, it's very clear that consumers are beginning to slow their activity. Coming out of the gate from the great the shutdown, we had a double-digit growth. Then we slowed to 8, 6. Now we're talking about bouncing around 2% on an annual basis. So while still positive, the consumer has clearly pulled back. And these other factors, as you mentioned, monthly payments for student loans, additional housing payments coming back online. This is going to compound the pressure on the consumer. Now, there are some temporary supports that we're still tapping into. There still is a sputtering of state and local stimulus. Consumers are turning to 401ks. Consumers are ramping up credit card debt. And with the relative health of the balance sheet, meaning we paid down debt during the closure, during the pandemic, there still is some wiggle room for the consumer to expand that balance sheet. So I'm certainly not suggesting that the consumer is going to immediately fall off a cliff. But what we are seeing is these indefinite supports beginning to wane, putting additional pressure on the consumer eventually as we head further into the second half of the year.
What do you expect Jay Powell to say in Jackson Hole next week, given all of this?
Well, I think one of the biggest questions that investors have is for how long? And that's really what I think Chair Powell is going to focus on. It's not necessarily how high, because it seems as if the committee is of one mind that we're nearing that terminal level. Whether it's 1, 2, maybe even 3 additional rate hikes, we're up near that sufficiently restrictive level. But how long will the Fed need to raise rate or keep rates, at that elevated level? I also think he's going to talk about the context of inflation against monetary policy. How does the Fed respond if we see a reversal in inflationary pressures? Is that even a scenario that the Fed is considering? And how does the committee balance the risk between raising rates even higher than previously expected, slowing the economy, against the risk of wanting to obtain that 2% inflation target? So there's a lot of questions that investors are going to be listening for, that I'm going to be listening for, in terms of how to gauge the Fed's mindset on these broader themes for inflation and monetary policy.
Lindsay Piegza of Stifel. And as we're speaking right now, you are seeing that 2-year yield just bump up against that 5% level, trying to see how long it can hold on. Just to take a look at the market reaction, it is as you would expect. She's trying to game out how high the Fed has to hike rates, but more importantly, for how long. And that does seem to be the tone across the board, watching the dollar space, because that has been one of the big surprises, that there was dollar weakness versus the euro, even in light of what we saw over in China. We now see that reassert itself. It actually has reversed after the knee-jerk response, where now it's 109.17, a little bit of euro strength versus the dollar. We should also just mention, in the slew of data that came out, we got Empire Manufacturing data for the month of August to read on manufacturing, and it came in with a downside surprise of -19. So there is this question around whether we're seeing a sort of bifurcated read and not a clear one in terms of real-time activity. If you are just joining in, we are seeing a decline in the equity market that's deepening after that retail sales surprise to the upside, down about 0.6% for the S&P, 44.77. We're also discussing what the ramifications are with respect to China, given the fact that we heard from Janet Yellen, Treasury Secretary, that there was some implication for the U.S. economy. Still with us is Lindsay Piegza of Stifel. Lindsay, what's your view on that? How interconnected are the two economies?
Well, I think they're very interconnected, and certainly we have to keep an eye on what's happening on the international stage as we see one of our largest trading partners now suffer a significant weakness in terms of the economy. Now, will this necessarily translate into further deflationary pressures? It certainly could help alleviate or help compound some of the disinflationary pressures that we've been seeing on the producer side. But again, for the U.S. economy, and more importantly, for monetary policy, what we're struggling with is the demand side of the inflation equation. And that's what the Fed is going to be focused on. That's what their focus is in terms of containing inflation.
Lindsay Piegza of Stifel, thank you so much for being with us. Janet Yellen speaking about the different programs that President Biden has put out there, but also saying that China's slowdown is a, quote, risk factor for the U.S. economy. Other people talking about some sort of decoupling and whether it's going to have an economic read-through, market read-through, what that's going to look like, how that's factoring into yields. Coming up, shifting gears a little bit, William Cohen joining us, author of Money and Power, How Goldman Sachs Came to Rule the World. After a bit of controversy over the CEO and growing dissent that is percolating into the news pages. From New York, this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
Today, in his first international media interview since becoming Taiwan's vice president, Lai Ching-te speaks to Bloomberg exclusively about his presidential run and managing relations with the U.S. and China.
Taiwan security is a global issue, and the peace in the Indo-Pacific region benefit all the country.
What kind of leader would he be? What are his plans for Taiwan? And what would they mean for the world? Tune in all day today, only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
David Solomon were to be fired today, I think the stock would actually go down. When I talk to investors aren't saying, oh, get rid of David Solomon. They're really asking the questions you're asking. Hey, does the media impact their performance? I'd say no so far. Having said that, David Solomon has to earn his job every day. And so I can come back in 3 months or 6 months and he doesn't get the job done, I'll be on the other side.
That was Mike Mayo, Wells Fargo, head of U.S. large cap bank research at Wells Fargo, talking after a New York Magazine article titled, "Is David Solomon Too Big a Jerk to Run Goldman Sachs?" Inside a banking mutiny. The discussion here, as people wonder what the path is forward, there have been a number of departures. Some people say it's within normal range. Some people saying that there's a real question mark at a time of tumult for the larger banking sector. Joining us now to discuss is Shonali Basak, Bloomberg Wall Street correspondent. Shonali, just to get started, what is the latest in terms of how Goldman is responding to this and how they're sort of setting it up given clear internal dissent?
This idea here that Mike Mayo had brought up, that performance has not been impacted. Listen, this year is a tough year for Goldman. The ROE has been the worst it's been in years, and we are splat dab today in the center of the third quarter. This is a pretty pivotal moment in terms of what Goldman would post at the end of this quarter. They have to finish their consumer strategy exits. They have Green Sky. They have balance sheet reductions to get through. And so this idea about performance being impacted by a lot of the distractions happening at Goldman, this is when it's being put to test most.
Why are people so fascinated with Goldman Sachs in particular?
They're the biggest. When it comes to the high-flying world of investment banking, Goldman Sachs has changed a lot. This was this closely held partnership. And when David Solomon came in, part of the promise was to open this up, be more shareholder-friendly. We are doing investor days now. But what happened was, with the personality traits that he has had, there has been a lot of friction between David versus the employees versus the media. And so that tension is now coming into the spotlight in a much bigger way, especially after the series of articles over the weekend. Now, the question is, are those another set of just articles, because we have seen kind of a lot of discontent over the years, or is it something where the rubber hits the road and starts to impact Goldman's performance moving forward? And this year is a big year to really set that mark.
Where is growth going to come from if it's not going to come from the consumer banking, and if it's a time of difficulty for certainly getting deals done and other types of investment banking activities?
A few things. They're putting their money on asset and wealth management, but here's a couple things about that business. That is where some of the balance sheet reduction is also happening now. So you saw things like a massive write-down on real estate when they had to sell assets and really exit some positions and take some markdowns. You also see them still fighting pretty hard in trading. I will notice, on a really positive note for Goldman, they have been beating Morgan Stanley in equities trading a couple quarters in a row there. So they have made strides. In mergers and acquisition, again, another pivotal year. For the first time in 5 years, they're still lagging behind JP Morgan on our own league tables. They are up in investment grade bond underwriting or high yield bond underwriting, but they're down in investment grade. So it's choppy, if you hear what I'm saying. And that's why this year is such a pivotal year for Goldman, because it's David Solomon's year to show whether this is just a lot of noise or whether it's impacting the core business lines that they're trying to prove are the future of the bank.
As Mike Mayo said, his performance has held up until now. When that changes, perhaps his mind will change, but as of now, not so much. Nali Bossack, thank you so much for being with us. Someone who has written about Goldman Sachs and all of finance for many, many years. William Cohen, author of Money and Power, How Goldman Sachs Came to Rule the World, co-founder of Puck, joining us now. William, I just want to start with, what's your take on the article in New York Magazine, but more broadly, some of the articles percolating out that really challenge David Solomon's leadership?
Well, the New York Magazine article, Lisa, was particularly personal and pointed. You know, having written a book about Goldman Sachs, I've read many, many, many articles over the years about Goldman. And of course, Goldman is always a focal point of the media's attention. It's become increasingly more of a focal point under David Solomon's leadership. In part, honestly, because he is disengaged from the media, which is a strategy I don't really recommend that he do, but, you know, he seems to be doing it, and I think some of the reason that you're getting these negative articles is because he does not engage with the media, which, you know, I think he'd be better off doing. But the New York Magazine article in particular was very pointed, very personal, very mean-spirited, and, you know, obviously Goldman is pushing back very hard against it. Almost like makes the New York Times article, which came out the same day, you know, an afterthought, even though it did contain that bit of news that supposedly Lloyd Blankfein called up David Solomon, the previous CEO, and asked him if he could be helpful, that he had, quote unquote, lost $50 million on his Goldman Sachs stock, and, you know, was willing to return if David would be willing to have him, which of course he said no.
That said, at what point does the increase in bad publicity and these public concerns, public airing of grievances that might be percolating up in the internal ranks really create a challenge to running a firm, right? I mean, at what point does executive leadership have to have the room? Does he lose the room and still keep his job?
Yeah, I mean, Sonali is right, and Mike Mayo is right. I mean, as long as the stock holds up, which it has, basically, it's you know, it's off its 52-week highs, all-time highs, but it's basically held up pretty well. it's up to the board at this point. I mean, the board has been incredibly silent, which is shocking to me. I think at some point, the board needs to come out in support of David Solomon. He's in a bit of a limbo now between all the complaining, all the griping, and these negative media articles. And it would be smart, I think, for the board to come out in support of David if, in fact, they do support him. I mean, now he's in this kind of weird limbo. I know from my internal conversations with people at Goldman that the board is not rattled by this. Maybe that's a good thing or a bad thing, but they have not come out with any kind of public support, which frankly would be smart to do.
What is the response internally when you have some of these conversations? Is it surprise? Is it this was a long time coming? Is it agreement? What's the sort of feeling that you get?
I think that there's some basic level of understanding that David is become a bit of a lightning rod and is somewhat of a controversial figure and is sort of a hard driving, CEO, take no prisoners type, which frankly, is sort of what Goldman Sachs is all about. So on the one hand, I think they're very supportive of David at the highest levels, as you would expect them to be. On the other hand, I think they understand that, especially because of the bonuses in 2022, the losses in the consumer sector that they're trying to put behind them. I mean, it's really all about the bonuses that were down in 2022, but you need to really look at it over a 2-year period. 21 was a huge year for bonuses, 22 not so great. So you put them together and people are still making an awful lot of money. But I would say that they are defensive and supportive. They know they're kind of in a battle, and that's why I say that the board should really put an end to this by coming out and either saying they support David or that they don't.
William Cohen, thank you so much for being with us. William Cohen there, author of a book on Goldman Sachs, longtime financial correspondent and writer in many capacities. Right now, if you are just tuning in, we are seeing markets on the move following an upside surprise to retail sales coming in. The control group, which goes into GDP, up 1% versus the expected 0.5%. We've seen that decline pretty much hold at about 0.5%. We've seen that decline pretty much hold at about 0.7 of a decline now, actually deepen for S&P futures. Yields higher, and this has been what's been gaining everyone's attention. 10-year yields, 4.23%. Real yields on the 10-year Treasury at the highest levels going back to 2009. We're also seeing right now the euro continue to gain against the dollar, which is sort of ironic considering some of the concerns over in China and this feeling that especially with better than expected data in the U.S., you should get the stronger dollar, the euro stronger actually. Now 109.24 after briefly dropping below the 109 handle. And we are seeing right now, just more broadly, this feeling that even if China does slow, you can see ongoing divergence. Oil prices, which had climbed and stayed above $80 a barrel, still slightly lower on the heels of what we heard over in China. Coming up tomorrow on Bloomberg Surveillance, Nikolai Tangent, the Norges Bank Investment Management CEO, on how to arrange in a world where investing in the index could be fraught when there is this sort of feeling that perhaps you can't divorce yourself from a sense of higher rates and slower growth. We also are looking forward to Target tomorrow and Walmart on Thursday, the latest read in consumers that seem to still have firepower. From New York, this is Bloomberg.
Markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The Fed, the market analysis. We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
A cruise
cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take
How
to do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more. Through just the design and the conceptual.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Yields up, stocks down. Live from New York City this morning. Good morning, good morning. Your equity market on the S&P 500 negative here. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the latest retail sales data coming in hot. China cutting interest rates by the most since 2020. As Yellen says the slowdown there poses risks here. We begin with the big issue, the consumer in America.
The U.S. consumer still remains extremely resilient.
The consumer is strong.
Very, very resilient.
Consumer sentiment is high.
Resilient consumer with their spending.
You're going to begin to see the impact on the consumer.
Demand cools just a bit.
The consumer starting to show some cracks.
Excess savings is starting to be exhausted.
Savings are being worked down.
Consumers are accelerating their borrowing.
There will be some headwinds.
Student loans. The consumer is going to come under increasing pressure. Inflation, food prices, oil prices.
There are a bunch of debts coming due.
Rates start to materially weigh on consumer activity.
It's how consumers behave, not what they say.
Retail sales surprising to the upside. Joining us now to discuss is BlackRock's Amanda Lynham, Morgan Stanley's Michael Kushner. Amanda, first to you. Bit of a sell-off again in the Treasury market. A 2-year briefly through 5%, a 10-year at about 423. Can we start with the data, Amanda? What did you make of that 30 minutes ago?
Yeah. Good morning, Jonathan. Thank you for having me. I think it kind of reinforces this resilient economic backdrop that we've been seeing for quite some time. And I think the major read-through for corporate credit investors is what does this mean for Fed policy and how long we stay in this restrictive territory? And so it's really less about what is the ultimate terminal rate, but more about does this resilient economic backdrop leave the Fed in a position where the bar for rate cuts is very high? high and they hold at this restrictive, tight monetary policy environment for a while. And that certainly has implications for the higher cost of capital environment that we've been expecting in the corporate credit market for some time.
Michael Kushma, let's build on that. What are the factors behind this resilient US consumer? And are they expected to fade anytime soon?
Well, I think it still comes down to that underlying story that coming into the rate hiking cycle, the household sector in general had hunkered down with refinancing their mortgage rates to, probably well below 3% for many people, and corporate consumer cash flows are pretty good. Interest rates go up on savings, and mortgage rates on liabilities don't go up, and you're aggregate okay. Of course, for certain sectors of the household sector who rent instead of buy, it's bad, and what's happened is not good for all households, but by and large, with nominal wage growth as fast as it is, and increasingly real wage growth as inflation falls, the household sector, again, in aggregate, looks pretty solid. And even with savings diminishing, there's no real stresses on them yet. With the unemployment way it is, job growth is 200,000 approximately per month, which was the average was the previous decade before the pandemic. Why should the consumer be too stressed?
Let's build on this then, Amanda. Is good data bad news for credit based on what you said?
I think to a certain extent it can be if we have this environment where inflation is showing improvement, but the economy is still strong, unemployment is still low, the labor market in general is still pretty tight. I think it removes a sense of urgency for the Fed to normalize policy quickly, and that certainly will have implications for corporate credit. I mean, we're already seeing it now. I would point to the Moody's default data that we received overnight. We're seeing an ongoing dislocation between the leveraged loan default rate and the high yield bond default rate, meaning the leveraged loan default rate is outpacing and continues to outpace the high yield bond default rate, and it feeds into exactly what we've been discussing, which is this higher cost of capital environment. The only distinction really between the leveraged loan universe and the high yield bond universe as it relates to that point is that those higher costs of debt are flowing through immediately for loan borrowers, but it's taking some time for the high yield bond universe for that to flow through. So to your question, if we stay in this higher cost of capital environment over time and we move closer to those maturity walls, that will eventually flow through. One of the questions we get asked a lot is, why is this not showing up in high yield spreads at the moment? And the reason is high yield borrowers, by and large, have the luxury of being patient at the moment. They've done so much refinancing, so much proactive liquidity raising in 2020 and 2021 that they don't need to act just yet. So they can still be patient, but it's only a matter of time before we get closer to that maturity wall, and I think that will flow through. Now, when you look at the corporate credit market, and Michael alluded to the dispersion that you're seeing at the consumer level, there's a lot of dispersion that's happening at the corporate credit level. So if you take that index level of 375 basis points of OAS in the high yield bond market, that in and of itself is tight. But if you look under the surface, half of that universe is actually trading below 300. So there's significant dispersion between the haves and the have-nots, and that's true within high yield, between high yield and loans. Certainly, as you get up into the investment grade landscape, it's a bit more resilient. But it's going to be a name of dispersion, I think, as we move through the next 12 to 18 months, and I think that will be key for corporate credit investors.
Amanda, could you frame for us just how painful that maturity wall might be? Let's pretend it's a month away. What's the difference between the coupon they're paying on existing debt and what they'd have to borrow at today?
Yeah, it's a great question. So I think the most instructive way to conceptualize that is to look at some of the sectors. At the index level, that differential is around 200 basis points, but for certain sectors, it's upwards of 300, 400 basis points or more. Now, we know that in practice, sectors don't issue debt, companies issue debt. But for some of those sectors that are facing, I would say, a combination of limited pricing power, secular headwinds, ongoing idiosyncratic risks, those mark-to-markets in the cost of debt will be significant. Now, corporates can offset that to some degree. They can issue less size. They could be strategic about parts of the curve that they target. They can try to be as opportunistic as they can about timing. But we do think that as that maturity wall moves closer, it will become a major story for corporate credit investors. And I think importantly, it's not just the 2025 maturity wall. it actually doesn't let up until 2029 in the U.S. high-yield bond market. So there's a significant quantum of debt that needs to be refinanced. And of course, we're coming off of record low supply years in 2022 and so far year to date, and record low coupons, owing it, of course, to the activity of 2020 and 2021.
And Michael, what's interesting about what Amanda just said is so much of this is known to some extent. We have some insight, some clarity on this. We know where the maturity wall is. What I'm trying to understand, Michael, is when do we start to worry about it?
I think it's by the middle of next year. By the middle of next year, we should see for sure a slowdown in the economy and the Fed able to bring down interest rates and maybe bring down the whole term structure of interest rates. But if some things have changed so fundamentally that real interest rates, the final term interest rate the Fed's talking about, I think one of the big risks for the Fed in the second half or the fourth quarter of the year is that they don't change monetary policy, but they say actually that 2.5%, final terminal Fed funds rate, maybe it's 3.5%, and the rate cuts you can expect are much lower because the demand for capital, the underlying strength in the economy is strong enough to generate that strong growth. And it may be very uneven in who benefits and who loses from that. So by next year, we should see in terms of who's benefiting, who's losing, and how much the Fed will give relief to what's going on. That'll depend critically on the inflation rate and to a lesser degree on the unemployment rate.
Amanda, is that the source of comfort right now, that this is a problem out there in the distant, and before we get there, the Fed's going to be cutting rates?
As you know, Jonathan, we think the bar for rate cuts is very high. So I don't think that near-term rate cuts in the U.S. are a likely outcome from here. Taking your question specifically on timing, if we just look at the math of it, the 2025 maturity wall is really what we're focusing on in terms of the beginning of those refinancing needs. We know that high-yield corporates in particular don't like to let their debt become current, so it's reasonable to think that they will start to address that 12 months or more before those maturity dates to avoid that situation. So I don't think it's that far off in the distance. I think really what this hinges on is the unemployment rate, the backdrop of economic resilience, and is there urgency from monetary policy officials to normalize rates. I think, we'll look towards the Jackson Hole Symposium for color on kind of the duration of how long we stay in this restrictive territory. But I don't think, and this is very consistent with our colleagues in the BlackRock Investment Institute, that the Fed in particular is coming to the rescue anytime soon from this higher cost of capital environment.
Equities this morning, 20 minutes out from the opening bow, down here by 0.6% on the S&P 500. In the bond market, retail sales pretty strong relative to expectations. Yields were higher, through 5% at the front end on a 2-year. Backed away since then, down about 2 basis points on a session now to about 4.95 on a 10-year. They were much higher, through 4.23, 4.26 briefly. Back down just sub 4.20 at the moment at 4.19.92. Joining us now is Bloomberg's Ira Jersey to break down the data from about 40 minutes ago. Ira, what did you make of that?
Yeah, so clearly the consumer is pretty strong. They like lower prices. We have to remember that even though inflation, and based on the CPI report that we received last week, it was generally still not in the Fed's comfort zone, goods prices were actually a little bit lower. So I think it just shows a propensity of the consumer to continue to purchase goods when goods prices aren't going up significantly. So I do think the data is better. I think that the big thing that we have to take away from this from a monetary policy perspective is not does the Fed necessarily hike more, but how long do they keep interest rates where they are now? So if the market starts to price out some of the cuts from that are being priced for next year, that's as good as a hike in terms of financial conditions.
We've said it a few times. It's not just how high, it's how long. Ira, thank you, sir. Michael Kushma, Amanda mentioned the Fed and Jackson Hole next week. We're expecting to hear from Chairman Powell. Michael, what would you expect to hear from him?
I think it's a bit complicated at the moment because we know the FOMC is a bit conflicted in terms of what they think we should do. Some members think we should hike rates further. Other things, we've done enough. We have to wait and see. Others think maybe we should have rate cuts if inflation continues to fall to keep real rates where they are. So you got 3 different kind of views at least amongst the board. So we'll have to wait and see how that plays out. So I don't think Chairman Powell can deviate from the current situation where we're waiting for more data. We're data dependent, and there's nothing else that we can say at the moment until we get more data.
Michael Kushner, Amanda Lynham on the latest with the Federal Reserve and the latest on the data as well. They're going to stick with us. Equity futures right now on the S&P 500, negative here by, let's call it 0.5%, with some movers around the opening bell about 20 minutes away. Here's Abby.
And a bit of a risk-off mood as you're talking about, John, but one big cap tech stock that is super resilient, NVIDIA, after rallying 7% yesterday, and Morgan Stanley saying that the recent, and in my mind, stealth 15% drop from the July top offers an attractive point of entry, and I should say recent top. Who knows, there could be another one. B of A filing today, boosting their price target. They report, of course, next week. The stock up another 2%. JP Morgan down 1.4%, falling amid this risk-off mood. Plus, there's some continued chatter about banks getting downgraded. Even the best of the best is feeling that pinch today. And then Tesla, well off of its lows earlier, down more than 1%, now down about 0.5% after they have rolled out a new base model X and S, but with a price tag that is $10,000 cheaper. Speaking of being off the recent high, Tesla off 22% off of its July high, John.
Abby, thank you. On the latest, more on Tesla with Ed Ludlow in about 20 minutes from now. Coming up, China's surprise rate cut.
We're going to need to see considerably more across different areas of policy for China in order to really give this recovery firm footing. There is such an accumulation of different problems and challenges facing China's economy. It's not just one thing right now.
That conversation up next.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
We're going to need to see considerably more across different areas of policy for China in order to really give this recovery firm footing. We'll need to see more coming on fiscal, given an absence of demand coming from other parts of the economy. I think we'll need to see more measures to stabilize property, given the latest warning signs there. And we'll need to see more follow through on these initial efforts to boost longer-term confidence.
Michael Hershon there of 22V Research weighing in on China's surprising rate cut. The PBOC unexpectedly cutting rates by the most since 2020 in hopes of bolstering an economy that's facing fresh headwinds from a worsening property slump and weakening consumer spending. Secretary Yellen acknowledging the risk of contagion, saying this: China's slowdown will have the largest impact on its Asian neighbors, but there will be some spillovers to the United States. The team coverage begins right now with Bloomberg's Kelly Nines and Tom Orlick joining us down in DC. Tom, just how bad are things down in China, and what can they do about it?
So what we've got right now, Jonathan, is a crystallization of risks for the Chinese economy. The property sector was already turning down, but repeated efforts by the government to put a floor under that downturn don't seem to have gained any traction. And now we have Country Garden, one of China's biggest private developers, apparently on the cusp of not being able to service its debts. Worse news, signs that that slump in the real estate sector are now spilling over into the financial sector, with one of China's biggest trust companies, one of China's biggest shadow banks, struggling to make its investors whole. All of that reflected in the July growth data, with industrial output, retail sales, fixed asset investment, all the big gauges of China's growth, missing expectations and pointing to a bleak second half. Well, the cavalry's on the way, but hasn't quite arrived yet. People's Bank of China cut interest rates by 15 basis points. Normally they move in 10 basis point increments, so 15 basis points is a signal, and there's a bit more oomph there than normal. Still, relative to the magnitude of the challenge which China is facing, and also relative to the enormous interest rate moves which we've seen from the Fed and the ECB and others as they battle inflation, 15 basis points really looks inadequate to the scale of the challenge. Expect substantially more stimulus from China in the days and weeks ahead as they attempt to put a floor under growth.
You're not alone. I've heard that plenty of times this morning already across the South Side. SocGen said this is unlikely to be the last measure. Katie, we actually heard from the Treasury Secretary acknowledging that this could be bad news for the US. To what extent could that be bad news?
Well, she did try to downplay this while acknowledging the risks, Jonathan. She said that she still feels good about U.S. economic prospects overall, while recognizing that China does indeed pose a risk factor. Of course, as the Treasury Secretary, former Federal Reserve Chair, she is not immune to the knowledge that anything that happens in the second largest economy and fragilities in it could have ripple effects around the rest of the world. She was, though, more careful in the selection of her words than, say, President Joe Biden last week, who at a donor event in Utah called the Chinese economy a ticking time bomb and said that they were in quote, trouble. And that trouble is feeding through to the U.S. policy response to China as well. Of course, we have heard repeatedly from not just Secretary Yellen, but others in the administration saying that they are not intending to hold China back economically with some of their policies or decouple these two largest economies in the world, rather using narrow, specific targeted things to protect national security interests, like that narrow in scope outbound executive order related to outbound investment into China last week. It's a very difficult needle to thread, not just geopolitically, as this administration is also trying to improve relations with Beijing, but economically as well, given the risks of spillover. We heard the Treasury Secretary acknowledging yesterday, John.
Katie, Tom, to the both of you, thank you. For a final word, Amanda and Michael back with us. Amanda, just a word on China. The financial stress that is emerging, the economic slowdown, how concerned should we be stateside, both from an economics perspective and a markets perspective as well?
Sure. I mean, I think from a risk sentiment perspective, it's a key factor to watch. I think really for investors, the critical point will be, does the contagion spread? And so as we know, the high yield property market in China has been under pressure for quite some time. We're seeing high double-digit default rates already year to date. So to some extent, that's a known risk. I think how much that extends both within the Chinese market, and then if it does extend more broadly globally, is a key impact. Probably in the near term, the focus for investors will be on dispersion. So are there sectors, are there companies that are reliant upon China for that next leg of incremental growth? What does that mean for the cyclical momentum behind those sectors and firms? And I think that's probably in the near term, absent future developments, what we should be watching.
Michael Kushma, final word, please.
Agree with that. I think in addition, many of our large trading partners in Europe have been highly dependent on Chinese growth for exports to China, and that we know Europe, for example, is struggling quite mightily right now across the board, and continued weakness in the Chinese economy can't be good for them, which then feeds through to the U.S., which are very large trading partners with the United States, and the U.S. trade deficit could easily get larger, subtracting from growth as import growth remains strong because of demand from the United States consumer. On the other hand, demand from outside the United States for U.S. products diminishes, which will detract from growth going forward, which again is not great.
Michael Kushma, Amanda Lynham, to the two of you, thank you. Plenty to talk about today. The US consumer, retail sales, plenty of earnings later on in the week as well. We'll hear from Walmart on Thursday. You'll hear from Target tomorrow, and plenty to talk about over in China as well. Disappointing growth all year, just not where we thought we would be. Relative to the hopes and dreams of the China reopening story at the start of the year, those faded and faded fast. Your equity market right now negative by 0.4% on the S&P, but slowly recovering as we inch towards the opening bell. In the bond market, that moves fades as well. Earlier this morning, that real sell-off continued. Yields higher, just about unchanged now on a 10-year, in and around 420. Coming up, the morning calls and later, Tony Dwyer of Canaccord joins us around the opening bell, recommending investors stay patient until there's a clearer outlook for rates and the Fed. That conversation just around the corner.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
5 minutes away from the opening bell, equity futures down across the board here on the S&P 500, negative by 0.4%. That's the price action. Let's get used to morning calls. First up, UBS raising its NVIDIA price target to 540, expecting shares to rebound on the back of next week's earnings report. That stock is up by 2%. B of A downgrading Valero to neutral, saying energy stocks could move sideways after their recent outperformance. We're down there by a little more than 2%. And finally, Evercore adding Discovery Financial to their tactical underperform list, seeing limited upside after the company's CEO abruptly stepped down. That stock is down by almost 9%. Coming up, stay patient until the clouds start clearing. That's the recommendation from Tony Dwyer of Canaccord. What he needs to see to start being bullish on stocks once again. That conversation coming up shortly. Your opening bell just around the corner.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
24 seconds away from the opening bell here. We're negative across the board as we have been all morning. S&P 500 futures negative 0.4%. On the Nasdaq 100 down by about a third, but improving as we get closer and closer to the opening bell in the United States. There's your opening bell in the States. Switch to the board and get to the bond market. Yields look like this on a 10-year, 419.92. Yields up by not even a basis point this morning. In the FX market, a break of 109 briefly, 109.41 right here, positive by a third of 1% on that currency pair. Let's get to one stock to watch at the open. It's Home Depot, the company topping earnings estimates, but starting to see signs of a pullback from consumers. The CEO writing, quote, while there was strength in categories associated with smaller projects, we did see continued pressure in certain big-ticket items. Abigail Doolittle has more. Hey, Abby.
Hey, John. Well, lots of nuances in this quarter, indeed. So on the surface level, as you mentioned, they beat, and they also beat in an important category of same-store sales, because they've actually had, over the last 2 quarters, declining same-store sales. The last quarter was down 4.5%. Well, this one came in down 2%, beating the estimate. So there is a positive there. They also beat the earnings and the revenue estimate. So again, positives, but yes, we do have that color from management that bigger ticket items, they're not really selling. On the other hand, the average ticket price did rise, suggesting that they are continuing to they're able to hold higher prices. Another nuance, though, the continued deflation of lumber and other items. If you recall, they actually lowered the full year guidance back in May. So that could weigh on other quarters, and they stuck with that lowered guidance. They didn't raise it despite the beat. That suggests that they're either trying to build a cushion for later this year, or they do in fact see weakness ahead. As for the stock, it had been earlier in the pre-market, now up about 0.7%, rewarding the company a little bit here. But on a bigger picture, John, this stock has essentially been stuck in a range between, let's call it 300 and 320, 340, somewhere in that range. They're probably going to have to put up better results than this to pop out of that range.
334 right now. Abby, thank you. Let's turn to the auto sector. Tesla shares under pressure after rolling out cheaper versions of the Model S and Model X. It's the company's second move in as many days to lower prices after offering fresh discounts throughout China just yesterday. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. Tesla actually just turning a corner, up 0.2%. It had been lower immediately following the open, basically flat now. Base models, or new base models for the Model S and Model X, are $10,000 cheaper than the prior generation. They have lower range. Remember, this is a low volume production vehicle. For Tesla, the S and X accounted for about 3.4% of overall deliveries in the first half of this year. But it does come 24 hours after you and I discussed Tesla cutting prices in China on the two variants of the Model Y, the long range and the performance, both cut by around $1,900 US. Tesla's not been afraid to use the lever of price cuts or introducing a new lower spec base model of these two S and X in a way to find new pockets of demand. And, you know, you and I have discussed this so many times that Musk and other Tesla executives are very clear that they are willing to sacrifice the bottom line and the impact to margins in order to protect that overall target growth rate of 50% annually. And this is another good example of that. But again, a lower volume production, and we're flat on the stock, Jonathan. It's a stock that's up 94% year to date.
Totally unchanged. Thanks for the update. Thank you, sir. Let's take it to the housing market. Warren Buffett's Berkshire Hathaway unveiling a big bet on US home builders. The company disclosing new positions in D.R. Horton, NVR, and Lennar, together worth more than $800 million US. This according to their most recent 13F filings. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, home builders certainly rallying today following that vote of confidence from Berkshire Hathaway. We're talking about D.R. Horton, Lennar, and NVR. Those positions were added in the second quarter. And of course, those stocks have been on a tear all year, given that big demand for houses has been met with a severe shortage of existing homes for sales. Now, in addition to these new positions, Evercore analyst Stephen Kim points out that Berkshire Hathaway already owns stakes in private home builders through Clayton Properties Group. So these new positions deepen that bet. And this was interesting, John. Evercore's Kim wrote that Berkshire's investment could help highlight, quote, the home builders' strong cash flows, healthy balance sheets, and favorable industry backdrop to a broader audience than the builder stocks have historically attracted. And you can see they're certainly seeing that love this morning.
Hey, Katie, thank you. Taking advantage of a frozen property market, the people with 2% mortgages don't want to move, and the people facing 8% mortgages can't really buy. Finally, hedge funds putting their faith in big tech and AI-related stocks. Institutional investors loading up on shares of Meta, Microsoft, and Apple in the second quarter. Tech stocks accounting for the biggest weighting in the group's portfolios at 28%. Shanali Basak has more. Hey, Shanali.
Hey, John, if you think about the tech buying you saw during the second quarter, perhaps not surprising given what you saw in the moves in the NASDAQ, but you do have to take a look at exactly what people were buying. If you looked at the top 5 holdings, it actually wasn't all big tech. A lot of it was Amazon, one of the top 5 holdings. And outside of that, in the top 5 holdings, you had buying of the iShares U.S. Treasury Bond ETF as the top buy for the quarter, as well as iShares Core Total U.S. Bond Market ETF being the third. So bonds being 2 of the 3 biggest equity buys in the ETF land when you look at what funds were buying. Now, we also have to talk about the movement we saw during the quarter, because hedge funds, as we know, are not static. 13Fs go through the end of the second quarter, and it has been weeks since then. So it is just as important to look at what people were selling as it was what people were buying. And you did see some of the biggest tiger cubs in the hedge fund land sit and start to pare their stakes in some of the biggest holdings. You also saw some of the biggest billionaire family offices also pare their stakes in massive tech names. Soros Fund Management exiting, Alibaba exiting Alphabet, Stan Druckenmiller's Duquesne also exiting the likes of Alphabet and AMD. So you did see some selling. But again, people were nipping back in the market at the margins here during a very healthy moment in the markets.
Shanali, you know it's that time of the year. We asked the same question. How useful are 13F filings?
Not very, because they are old. However, the direction of travel is important to watch here. In addition to the 13F filings, we had also recently, for example, John, gotten a note from Goldman's Prime Brokerage that is putting out their outlook for the rest of the year. And it says a lot of what we see in the 13Fs, where it's credit. It is bonds. It is not equities. That is the biggest question and the biggest kind of point of excitement here for the biggest investors.
Shanali, thank you for the update. We're about 6 or 7 minutes into the session. Equities are lower here by 0.4%. Not quite as bad as it looked earlier on this morning. Similar story in the Treasury market. Yields were much higher, now higher by just a couple of basis points, the 10-year at about 4.21. Tony Dwyer of Canaccord recommending equity investors stay patient, writing this: the time to be bullish may be when bad news becomes bad news. The better economic performance reinforces a recession over the coming quarters because it keeps the Fed's rates higher for longer. Historically, the catalyst for forward growth is a much more favorable outlook for money that only comes with a rapid drop in rates. Wait for the clouds to clear. Tony, I'm pleased to say, joins us right now. Tony, is that another way of saying this soft landing talk is also bad news?
So, John, I've been kind of public with, I think the soft landing scenario is the worst case scenario. And the reason is because it keeps rates higher for longer. When you're in a generationally levered system on debt to GDP, the longer that you keep rates elevated, the more interest expense you're going to have over time. For example, let's just think of common sense, for the viewers and the listeners. How many people have you heard get loans in the last 3 years where there was no interest payment for a year? So all of a sudden you fast forward and your interest payments could potentially be a lot higher. And I think ultimately that's why people, like you said, are stuck in their house. Mortgage rates, listen, you need an improved outlook for money. When I look at the soft landings of 1995 or 1966, in both of those cases, you had a 200 basis point drop in short rates. We have government interest rates at the same level as a year ago, corporate interest rates at the same level as a year ago, mortgage interest rates at the same level as a year ago. So let's even assume a soft landing can magically happen. What's your next catalyst for double-digit earnings this upcoming year? And I know people would say, well, productivity, and certainly that could help, but you really need a revenue pump, and I don't know how you're going to do that with money where it is.
Tony, these issues around rates, do they speak to the recent developments in the bond market? I've asked this question a few times over the last week. Just what is the dominant factor underpinning this bond market move, with yields back up to about 4.20 on a 10-year and close to 5% on a 2-year?
Well, I got to say, it happened right after Janet Yellen announced an increase of 1/3 in Treasury new issuance. I mean, you're financing paper now at over 5%, no matter where you are on the curve. That was zero. It was 0.5%. So the issue that we have here is, for a generation, the refi cycle is probably broken, because I look at my own household. I have a 2 7/8 mortgage. For me to be able to refinance that mortgage and take money out and do it affordably with anywhere near the same monthly payment, you're going to have to get the 10-year back down toward 1%. And imagine what the employment picture would look like if that's the case. So, there are some offsetting positives. This is, sounds Armageddon negative. The offsetting positives can be that private credit is kind of stepping up into a place where the bank credit is falling.
Listen to you, Tony, showing off. I've got a 2 handle on my mortgage. Tony, that's like saying you've got a Lamborghini on the drive in 2023.
But I'm pretty good at being wrong in the stock market, but my mortgage trades have been
Tony, you're kidding me. I wish I had a mortgage with a 2 handle, locked in for 30 years. Tony, I've had a lot of people tell me that we can't sustain life above 4% on a 10-year, that this isn't sustainable. Do you endorse that view?
I don't think it's sustainable. John, for example, this morning, I have this great research assistant. His name is Google. So I just Googled, strong retail sales, and better than expected prior to recession. I went back and I looked at 2007. In November 2007, you had a huge move up in retail sales, and the reason was better than expected income growth and full employment, better consumer confidence. So, all you have to do, I believe, in this thing is try to maintain patience. And what we're going to do all day, unfortunately, you have to do it and I have to do it. We have to comment on what the stock market's doing in this half hour. And what we found over the course of this year, last year, and the year before is that intraday volatility has become so extreme. I think that information is useless. What is useful is, where are we with employment? And that's been pretty good. And where are we with interest rates? And that's not so good. So ultimately, when the higher interest rates, if they stay higher for longer, do bite into the interest expense and companies have to pull back a little bit, that's when the unemployment picture starts to rise. That's when bad news becomes bad news, and that's when I want to attack. The time to be seriously negative, in my view, was last August, and man, did I feel dumb last August. Market was ripping, and as you remember, I'm sure you remember, I was pretty negative, feeling really wrong, and then we went into the October swoon as rates started to really ramp. Now, I believe, is the time as stocks pull back, John, to try to take advantage when bad news becomes bad news, because that's when the outlook for money improves as the Fed cuts rates.
Tony, do you feel a repeat of that late summer story coming into September last year?
I think you got a buffer, John, and I think part of it is, like, for example, 3 or 4 months ago, nobody in China was talking about a 100 basis point rate cut. So, things change fast when unemployment starts going up because it becomes a political influence. So, yeah, I do think we can have a sharp sell-off. I don't think we're probably going to go back to the October lows. You don't need to. I think a good enough sharp sell-off that really comes from worse economic data and the employment picture that helps the Fed really in expectations for Fed rate cuts have the 6-month, the 2-year come down hard. I mean, think about this, John. You and Lisa earlier this morning did a great job of talking about mortgage paper. So we're at a 7.25 on a 30-year fixed conventional mortgage. That comes because there's a historic spread, wide spread between 10-year treasuries and mortgages. If you have the Fed cut 100 basis points, and if you have that spread go back to a more normal level, if you stop QT or at least pause it, then all of a sudden you got a 200 basis point drop in mortgage rates. And when that happens, you can really kickstart maybe the next economic cycle. I don't know how you're going to magically do it without a real drop in rates.
Tony Dwyer, Chief Market Strategist at Canaccord and owner of a 2% mortgage. Tony, thank you, sir.
2 7/8, buddy. 2
7/8. Just
Very
sounds,
close to
I'm making it sound
up.
even better for you, Tony. Go away. Tony, thank you. I'm so jealous, honestly. The mortgage envy is real. Your equity market on the S&P 500, slightly negative this morning. Coming up, Secretary Yellen leading the Bidenomics PR tour.
The administration remains committed to taking actions to lower prices for Americans where we can.
That conversation coming up shortly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's always for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
administration remains committed to taking actions to lower prices for Americans where we can. And we continue to monitor developments, particularly those abroad, that may affect prices and growth.
Secretary Yellen praising the president's economic policies in Las Vegas. The administration celebrating the one-year anniversary of the Inflation Reduction Act, with Vice President Kamala Harris speaking in Seattle, President Biden addressing voters in Milwaukee at 2 p.m. Eastern. This all ahead of his big speech Wednesday from the White House. The president trying to ramp up voter support as presidential candidate Donald Trump gets indicted in Atlanta over efforts to overturn the results of the election defeat in Georgia.
The indictment alleges that rather than abide by Georgia's legal process for election challenges, the defendants engaged in a criminal racketeering enterprise to overturn Georgia's presidential election result.
Let's get to the Bloomberg team. Kelly Lyons and Mario Parker joining us down in Washington, D.C. Mario, first to you. What's the latest, please?
Well, the framing that you had in your introduction, Jonathan, I think was spot on, right? You got President Biden going to Milwaukee, a city and a key swing state, to tout his economic agenda ahead of the 2024 election. And you've got former President Donald Trump down in Georgia, another key state, with the latest indictment. One thing to be sure about with former President Donald Trump and how he's using these indictments to try to capitalize and fuel his political comeback is that they're indistinguishable at this point from his campaign.
Katie, is this just drowning out the campaigning of President Biden on his Bidenomics tour, or is it helping him?
Well, it's hard to compete with the headlines, right, John, as so much media attention has been placed on the legal woes of the former president. But the current president is trying his very best, not just him, but others in the administration, other surrogates on this 10-state swing this week to celebrate the one-year anniversary of the Inflation Reduction Act. As you pointed out, there will be an event at the White House tomorrow. But before that, today, the president will be in Milwaukee, Wisconsin with this message. It's important to note the significance of that location choice as well. Wisconsin, of course, is a critical swing state. He won it by a narrow margin over Trump in the 2020 election. And the city of Milwaukee is also the location of the first Republican primary debate that is taking place next week. Now, as for whether or not this messaging really is going to resonate, to this point, despite what the president has touted as growth in the economy from the middle out and bottom up, it isn't necessarily showing in the polling. Still, a majority of Americans disapprove of his handling on the economy. That is consistently shown in surveys. His approval rating also remains low overall, and so that is what this tour really is intended to rectify. But definitely some oxygen being sucked out of the room by his likely opponent in a general election if the current stance of the race holds
Mario,
as it is now, John.
Can you jump in and translate this for me, this headline that crossed from CNN just moments ago, that Hunter Biden's top lawyer has asked to withdraw from the case? What does that mean, Mario?
Well, it means that now we've got the former president kind of dogged by investigations, and it looks like the White House, much to its chagrin, from where they were thinking things would be at least 2 weeks ago, will also have an investigation kind of hovering over the 2024 election as well. This isn't great news for the president. I mean, Republicans, going back to the 2020 cycle, have tried to make his son, Hunter Biden, a focus of their attacks, and it's a weak spot for the president going into 2024. It allows Republicans to engage in whataboutism, as to Kaylee's point, as former President Donald Trump is embroiled in his own investigations.
That headline just crossed in moments ago. Mario, Kaylee, to the two of you, thank you. Just to share that with you again from CNN, Hunter Biden's top lawyer asking to withdraw from the case. Plenty more on that, of course, on Balance of Power a little bit later at 5 p.m. Eastern Time with Katie Lyons and Joe Matthew today. I'm told that Anne-Marie's going to be back tomorrow. About 21 minutes into the session, we're down by 0.6% on the S&P 500 with a sector price action. Here's Abby.
And with that sort of decline, John, we are looking at all 11 S&P 500 sectors lower today, led by energy down 2.1%. We also have materials, financials down on the bottom, down more than 1%, joined by utilities up top. Interestingly, technology down just 0.1% or thereabouts. However, on the month, it's a different story. So the month of August for the S&P 500, we're looking at a greater greater than 2% decline. That's the worst month of the year, and this is one of the worst sectors. Technology down 5.4%. Earlier I was talking about those stealth sell-offs for Tesla, or at least the degree of them, and NVIDIA. Well, this index is also heading to its worst month right now since December of last year, John.
It's had a tough go of it over the last few weeks, that's for sure. Abby, thank you. Coming up on this programme, your trading diary.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
25 minutes into the session, it's certainly not as bad as it looked earlier on this morning, off the back of more weak data from China and a rate cut in the mix as well. We're down about 0.6% on the S&P 500. Not as bad as it was, because it's not as bad as it was in the bond market too. If you switch on the board and get to the bond market, yields are right off the highs of today, with a 10-year yield right now at about 417.57. A 2-year, that yield's declining now to about 492. Only an hour and 30 minutes ago, that was through 5%. Very, very briefly. Since then, we've backed away. So that sell-off in the bond market slowly getting bought in the last 30 minutes or so. As the price action, here's the trading diary. Coming up, the Fed speak from Neil Kashkari of the Minneapolis Fed. That will take place at 11 a.m. Eastern Time. President Biden discussing the U.S. economy from Milwaukee at 2 p.m. this afternoon, then delivering remarks on the Inflation Reduction Act from the White House tomorrow. Plus tomorrow, Target earnings before the opening bell, and in the afternoon, some Fed minutes in the mix as well. Walmart numbers and another round of jobless claims, they come on Thursday, and finally, we round out the week on Friday with Eurozone CPI. That rounds out the morning for me. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
do you want to be a consultant? And what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Could face bigger challenges next.
It was going to keep rate while this is a 3.
As the economic picture does. The OK is getting ready to make a decision.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Lots of news that there, lots of eco news. We got earnings news. We got it all for you. We got some geopolitical news. That's where we're going to start off today. Kaylee Lyons, anchor of Bloomberg TV, is going to join us, give us the latest on what we know from the fourth indictment of former President Donald Trump, this time out of Atlanta. Plus, Home Depot reported some results. We're going to check in with Drew Redding, senior home buildings analyst for Bloomberg Intelligence. He also covers all the home builders, and we'll get a sense of, are they building houses now? Why not? Because there's no supply out there, and we'll get the latest on the Home Depot news as well. But first, let's check in with Amy Morris and get a Bloomberg Business Flash.
All right, thank you, Paul. Treasury Secretary Janet Yellen also watching those international developments you were referring to that may have consequences for prices and economic output in the U.S.
The administration remains committed to taking actions to lower prices for Americans where we can. And we continue to monitor developments, particularly those abroad, that may affect prices and growth.
Secretary Yellen reiterated her view that U.S. inflation can ease without hurting employment. We check the markets all day long right here on Bloomberg Radio. The Dow down 0.6% or 215 points. S&P 500 down 0.7% or 31 points. NASDAQ down 0.7% or 94 points. The yield on the 10-year now 4.18%. The 2-year yield at 4.92%. NYMEX crude oil trading at $80.86 a barrel. That's down $1.66. Brent crude down $1.37 or now $84.86 a barrel. I'm Amy Morris. That's your Bloomberg Business Flash. Matt and Paul.
Amy Morris, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in the Bloomberg Interactive Broker Studio. And, of course, we are streaming live on that YouTube thing. I think that's the interweb. You can just go to YouTube and just search Bloomberg Global News here. Lots of eco data. The consumer looks pretty darn strong. The retail sales numbers came out, and I was like, wow. I mean, I don't know where the consumer's getting the money, but the consumer's spending out there.
I always say, these markets tend to underestimate the U.S. consumer. We all do. And typically, the consumer is just so strong. I agree that I have no idea where the money's coming from, because it seems like the consensus now is that all of the excess savings built up during the pandemic have been spent. Or at least will be spent by the end of the year. Right. But they're definitely putting more on plastic.
Putting more on plastic. And then we've got they got to start repaying your student loans, I guess, come October, and that will be a drag.
Oh, look at this. Hawaiian Electric Industries cut to junk by S&P.
Yeah, that's tough there. That's going to be an unfolding situation on that island for a long time. So obviously, we'll stay on top of that. Red on the screen here today, S&P office 0.7%. We've got some earnings in addition to the eco news. Let's check in with Bailey Lipschultz. He covers all the markets for Bloomberg News. He joins us here in our Bloomberg Interactive Broker Studio. Bailey, what do you got this morning?
Yeah, all 11 sectors in the S&P in the red. Energy and materials down more than 1%, as is financials and utilities. Worst performer in the S&P this morning, Discover Financial Services. That comes after the company's CEO resigned as the board. Vows a renewed compliance focus, so DFS, your ticker, down right now about 8%. Another stock keeping an eye on, obviously, is Home Depot. Right now up 1%. The big thing that stood out from those results is that the outlook, according to Wall Street, seen as conservative, and the slowing sales slowed actually year over year, much less than Wall Street was forecasting. So you're looking at a stock trading around highest level since early February in Home Depot. And then I know, Matt, you're partial to European companies. On holding, the shoemaker that is backed by Roger Federer, down 15%, blaming the strong Swiss franc as an FX headwind. Stock's still up more than 70% this year, but ticker ONON down 15%, even though earnings, broadly speaking, were as good as Wall Street could have expected.
Oh, that trades in the U.S., huh?
Yeah.
Interesting. I mean, that's a huge drop, 15%.
And this is the company that it's become all the rage. Hoka on shoes. I don't know what kind of shoes you normally wear. I'm a Vans
I haven't
guy.
worn sneakers off of the squash court for probably 2 decades.
Rich Truman today is sporting brand new sneakers that just unbelievably bright white.
Very
mean, sharp.
That's not. I feel like there are shoes that you wear out in regular life. They're normal shoes, are not tennis shoes.
But here's what the trend is recently in the last several years: wearing a suit, men wearing a suit, but then having those kind of sneaker-like things. They're dark with the white soles.
The Allbirds.
Yeah. Even David Weston, who I have such immense respect for.
I have respect for him too.
He's
but it
walking
doesn't
around
fly
with
in
these
my
things.
book.
So
No.
Exactly. So I don't know what's going on.
You know, get yourself a pair of Red Wing Iron Rangers. That's a man's shoe.
Bailey, I don't know if you got the Red Wing Iron Rangers, but what else you got for us out there in the
not.
marketplace?
10-cent Music reporting results. The ADRs right now up about 1%. Forecasts kind of a little bit less than maybe Wall Street was looking for. Kind of a mixed quarter coming out of that company. Again, you're looking at a market right now kind of on the back of some economic data. We're in the middle of the summer lull, so volume's not really that sharp in either direction this morning. But another stock that's under pressure is Getty Images. D-SPAC, so went public via Blank Check Company, which is my bread and butter, down more than 7.5%. Hollywood strike weighing on expectations. The CEO talking about how challenging the second quarter was, cutting their full year forecast below what Wall Street was looking for. So I feel like most people are familiar with Getty right now. It's about $1.7 billion in market cap, under pressure and trading kind of down to the right, which is really is done for the last 12 and so months.
All right, so there's not much going on. I'm still, the Home Depot numbers we'll get to with Drew Redding, but again, the consumer kind of still there, and I'm just kind of wondering where, again, all the cash is coming from.
Yeah, I mean, the one thing the CEO did call out, though, is the pressure in big-ticket items. So one thing to keep an eye on with that is just kind of when you look at the makeup between Home Depot and Lowe's consumers and kind of the different spending patterns that they have. That's one thing to keep an eye on. Obviously, Lowe's did also unveil a $15 billion share buyback program, so that certainly doesn't help. Lowe's ticker LOL right now down 0.7%, so underperforming Home Depot by just a touch.
All right, very good. Bailey Lipschultz covers all the markets for us, and we appreciate that. S&P 500 off 0.9% here. So lots going on out there, lots of eco news, lots of company news. need to stay on
so much
top of that.
geopol, right? I mean, I look at the top stories of today, and it's got to be like Trump indictment, China cuts rates, Russia raises rates, and Hawaii governor says Lahaina residents can't sell their properties.
Yep, and that seems like, wait a minute, I thought it was private property. Can I do what I want with it? So we have to see how that plays out, because there is a lot of moving parts there, and people are trying to figure out what to do next. All right, let's get to the political story that is of the day. That would be the fourth criminal indictment of former President Donald Trump. I want to bring in Kaylee Lines, Bloomberg Television, TV and radio host. She joins us here. Plus, former federal prosecutor for the Department of Justice, Michael Zeldin, joins us as well, so we appreciate that. Kaylee, let's start with you here. What's the feeling in D.C. about this fourth indictment, and likely, presumably, the last one we'll get here?
Well, we've all been waiting a really long time for this. It had been some time that Fani Willis, the district attorney in Fulton County, had said that she would bring these charges in August. So there is some relief, I guess, that has finally happened, and we all have to stop the waiting game, and now it really is more of the what happens next game. That said, this is, as you say, the fourth indictment. We have already seen this song and dance 3 times already, so I feel like there is a bit more of it's another one sense here relative to, the history being made of that first state indictment in New York and then the first federal indictment in the classified documents case. And so the fourth one, while definitely significant, given its wide range, how the violation of the RICO Act he is accused of does carry a minimum sentence if found guilty of 5 years. It definitely is significant, but it's a moment we have long been expecting.
Michael, first of all, thanks for joining us. I got to ask you about the tactical differences between the Jack Smith prosecution of just Trump and, it seems like he's really honed in. He doesn't want to be distracted by any other defendants. And Fani Willis, who has, how many people has she indicted?
41, I believe.
18 people.
19, okay.
19 people. 19 people. It seems like that would just take a long time. Everybody's got a different scheduling problem. I mean, how is this going to work out?
Well, a whole lot of people are going to enter pleas. All of the people on sort of page 2 of the indictment, they have to get out from under the RICO charge. RICO charge carries a 5-year mandatory minimum, and these lesser people are all going to say to the prosecutor, please let me plead guilty to something other than RICO. If you need me to cooperate, let's see if I have anything that's worthwhile to you. But this case, I think, is going to get skinnied down pretty quickly because of the RICO charge. And I think you'll have a multiple defendant case. But Fani Willis decided that that was what she wanted to tell the jury, this multi-part, multi-purpose indictment with a lot of people trying to undermine the voters' rights in Georgia, and that's her prerogative. It's a sovereign state, and that's what she chose to do. I don't know what the timing will be in relationship to Jack Smith case, and I don't know how it'll work with some of the overlapping witnesses, but that's for them to work out between them.
Hey, Kaylee, the Biden administration has been noticeably quiet during the prior 3 indictments and just kind of during the whole process here. Is there any reason to think that will be different here, or now that we've kind of got the final one, maybe they'll have a holistic kind of comment?
Well, certainly this isn't going to be an issue that the administration, or more specifically the Biden campaign, is going to be able to avoid, especially in the general election, should, as is presumed now, Donald Trump be the Republican nominee. They are going to have to deal with this litany of legal issues and address them and make the case why, Biden would be a better president than Trump, in part for those reasons. That said, given perception on the side of many in the Republican Party that this Justice Department under President Biden is being weaponized against the former president, I think the administration is being very careful here to not comment for concern about how that may be perceived and feed into that notion that this is politically motivated, as the former president himself and others close to him have suggested that all of these indictments are.
And Michael, I just want to get your thoughts here. Now that we have 4 of these indictments, could you help us just put it all in context? Where is the real risk here for former president?
By the way, I got to say, just quickly, Paul, it's a strong presumption that this is the last indictment Donald Trump faces.
That's a fair statement. That's a fair statement. Of we currently know, I guess, is probably the way to phrase it. So, Michael, how do you put them in? Where's the real risk here for the president?
I think they all present different risks. You know, if you were going to say which is the most serious, which is the least serious, perhaps Georgia is the most serious because of the mandatory minimum. But each of these cases is an important case for the president, former president. Each has the opportunity for him to come forward and testify and say why this isn't true. We'll see whether he chooses to testify in any of these cases. So I think, you know, it's hard to sort of guess which one is the most significant, because they're all significant. And all of them are felony, indictments, and all of them carry jail time. This one just carries mandatory jail time, which is why I'm putting it at the top of the list. But it's very hard to handicap them in that way because they all have different issues and present different opportunities for Trump and opportunities for the prosecutors.
Michael, I want to ask about not the former president's indictment issues, but the current president's son. Hunter Biden was assigned, the probe of Hunter Biden, a special counsel. And what difference does it make? I mean, this investigation has already been going on for 5 years by a Trump appointee. How do you see the difference here as a special counsel?
I think it's really more form over substance. I think that because the plea deal broke down, and therefore because the case is ongoing, and because there are possible Foreign Agent Registration Act links that at least the politicians have been saying take us back to President Biden when he was vice president, that Garland just made a safe decision to say, let's just designate him as a special counsel and strip the politics of this even further. But I think it's really more form over substance. Weiss is the guy who's been investigating this for all these years. He's the special counsel, and I think business will go on as usual, except, of course, nothing is usual in this case.
Kayleigh, just following up from the Washington perspective here, as it relates to Hunter Biden and his legal issues, what are we hearing from the Biden administration, the Biden campaign, as to the risk here?
Basically nothing at all, to be honest with you, Paul. This is an issue that President Biden is very reluctant to touch. He actually didn't even say anything about it on Friday when the special counsel was named. To this extent, when we heard the plea deal first announced, that of course has subsequently fallen apart earlier this summer, all the president and the first lady said in a statement was that they love their son and they support him as he continues to rebuild his life. This is a very touchy subject for the president in regard to his son. Again, like Trump's legal issues, this isn't going to be something, as he campaigns for re-election in 2024, that he is going to be able to avoid forever. This is something that is going to continually be a focus on him and his family, especially not just in terms of this probe that is happening with the special counsel, but also in Congress, where they're investigating, to use the words of the chair of the Oversight Committee, James Comer, the Biden crime family. It's something that's going to continue to dog him, but it's something to this point he has proven very reluctant to actually openly talk about.
Yeah. Michael, former President Trump now faces 4 criminal indictments. Who is representing him, and is he getting, quality representation?
Well, this newest lawyer, Lauro, is reputed to be a very good lawyer. I have friends who know him up from Florida, and I think he will do a good job for the president if the president does a good job for him as a client. Right now, the biggest problem with Donald Trump from a lawyer's perspective is containing him. He was just in court the other day, and Judge Chutkin in the D.C. District Court in the January 6th styled case said to Trump, here are the parameters of what you can and can't talk about. We're not going to try this case in the public domain. Does everyone understand what's going on here? Everyone, yes, agrees. Lauro says, yes, on behalf of my client. He understands the protective order. The next day, he violates the protective order. So we're going to have to see how Lauro can control his client. We're going to have to see how Judge Chutkin, if he can't get him under control, sanctions the behavior of the president. So he's got good lawyers. He's just not a good client. And, good lawyers can only do so much with a bad client.
All right, Michael, thank you so much for joining us. Really appreciate getting your informed perspective. Michael Zeldin, former federal prosecutor for the U.S. Department of Justice, and Kaylee Lyons, Bloomberg Radio and Television, joining us from Washington, D.C., giving us their perspective there as well. So again, the fourth indictment of former President Donald Trump, that's now been released, and now I guess it's a political issue as well as a legal issue. So we'll stay on top of that, of course. S&P 500 off 0.9%, about the same for NASDAQ and the same for the Dow Jones Industrials. This is Bloomberg. Let's get company news right now with Lisa Mateo.
You got it. It looks like U.S. consumers are spending more on home improvement than expected. Home Depot's earnings topped estimates, and the company reaffirmed its fiscal 2023 outlook. But there is one point of concern. Bloomberg's Steve Podisk reports.
CEO Ted Decker says while there was strength in categories associated with smaller projects, continued pressure remained in certain big-ticket categories. Home Depot expects comparable sales to decline as much as 5% this fiscal year, even as it remains positive on the outlook for home improvement.
Now, shares of Home Depot are up right now about 1%. And if you ever wanted to own a Tesla, but the price tag was holding you back, now's your chance. The company is rolling out 2 lower spec versions of its less popular Model S sedan and Model X SUV in the U.S. and Canada that cost $10,000 less. Bloomberg's Kimberly Adams has more.
The cheaper versions come with less range and slightly slower acceleration than the base models. Just yesterday, Tesla cut the price of its higher spec Model Ys in China, fueling concerns of a renewed price war in the hotly contested Chinese market.
Now, shares of Tesla right now down about 1.5%. And the Clorox company says it's identified unauthorized activity in its computer networks that has disrupted some business operations. Now, as a result of all this, the cleaning products maker has taken some of its information technology systems offline. Clorox says that it's continuing to work with law enforcement over that issue. Shares of Clorox right now down about 1%. Those are the company stories we're following this hour. We'll have more Bloomberg Markets with Paul and Matt in just a bit. I'm Lisa Mateo, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
$10.21 on Wall Street. I'm Amy Morris. Hawaiian Electric Industries cut to junk by the S&P after several class action lawsuits tied to those devastating wildfires in Maui. Hawaiian Electric shares now down nearly 7%. We check markets all day long here on Bloomberg Radio. The Dow is down 0.8% or 291 points. S&P 500 down 0.8% or 37 points. And NASDAQ down 0.8% or 108 points. The yield on the 10-year now 4.18%. The 2-year yield at 4.92%. And let's check U.S. Steel. It is now down 3.3%. I'm Amy Morris. That's your Bloomberg Business Flash, Matt and Paul.
All right, Amy Morris, thank you so much. We appreciate it. Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We are streaming live on YouTube. Just head over there and search Bloomberg Global News. I'm looking at Home Depot. The stock is up at 1%. They reported some results that beat estimates. Apparently, the do-it-yourselfers out there are still spending. I don't relate to that whatsoever, but I do have a toolbox in my house, but that doesn't get a lot of use.
I have so many tools.
You do?
But I don't really do that much with them.
I'm not your guy for that. But Drew Redding he's a research analyst. He covers all the home builders for Bloomberg Intelligence here. So, Drew, it looks like, I mean, people went crazy during the pandemic, buying stuff and fixing up their houses. And I thought we'd see a big drop-off post-pandemic. Doesn't appear that that's happening.
Yeah, that's right. I mean, Home Depot is still going to do somewhere around $150 billion in sales for the year. That's up more than 40% since 2019. But we are seeing a slowdown this year. The company called out ongoing pressure in bigger ticket discretionary items. Part of that has to do with the inflation we've seen. Part of it has to do with the pull forward of demand over the last couple of years. So think of certain categories like patios or grills or appliances where you make that purchase 1 year, it's going to be a while before you purchase it again. So that's part of the slowdown. They have noted a little bit of strength in smaller tickets, which has helped to offset some of that weakness. But generally speaking, the company still expects sales to be down 2 to 5% this year.
How are they doing in terms of competition, Drew? I mean, are they winning the fight with Lowe's, or does it really just come down to whoever has the store nearest you gets your business?
I think that's part of it, and Home Depot's massive store footprint has always been a competitive advantage for them. One of the reasons why we like them and why they've been winning over the last couple of years is because their exposure to professional customers. It's about 45% of sales. It's about 25% for Lowe's. So the pros, while their backlogs are starting to slow a little bit, they're still very elevated from where they were over the last couple of years. And, as we look forward, they're starting to dive deeper into the pro category through what they call complex projects. So you think of a contractor who has relationships with, many suppliers, whether it's for paint, flooring, you name it. And, they have to go to 10 different suppliers. Home Depot wants to consolidate all that and be the single supplier for larger contractors taking on more complex jobs. And we think that's a big growth opportunity for them.
So when I walk into a Home Depot, which granted isn't very often, but when I do walk in there, I'm just blown away by all of the inventory they have there, the SKUs, as you retailer call it. How are they managing inventory? I mean, are they like a lot of other retailers where they had too much inventory there coming out of the pandemic?
Yeah, they've really worked their inventory levels down very significantly. They've highlighted they still have a little bit of more work to do, but at the same time, what they've done is they've improved their in-stock position, which has been a focal point for them. So their in-stocks are actually better than where they were over the last couple of years. So that's really, what they're focused on, and they've made good headway in that regard.
I was in there on Sunday.
No.
We have a big Home Depot out in Yonkers. I was looking for a 1/8 inch BSP pipe cap.
No, you weren't.
Yes, I was.
Wow.
Because I blew the O2 sensor bung off the exhaust pipe of my Ducati Monster.
Sure, I hate when that happens.
And I was looking for some high heat Loctite. Now they had the pipe cap, which I was impressed by. In fact, I looked first online and saw they had 10 in store, and I was like, wow, they never have it in store. But the Loctite they didn't have.
What are you gonna do?
So Sunday, dealership closed. Monday, dealership closed. Motorcycle dealers always close Sunday and Monday. Today,
I'm gonna go get it fixed.
That's right. Yeah.
Hey, Drew, talk to us about the housing market in general here. I mean, we've got interest rates, mortgage rates, north of 7%. Nobody wants to get out of their house with their 3% mortgage and try to move to somewhere else with a higher mortgage. Is there a level that you hear from maybe some of your home builders where they think if the mortgages get down to some level, is it 5%, is it 4.5%, then that'll free up the market. Where are
This is Paul hoping that mortgage rates come down next year because he has an adjustable rate mortgage that he wants to refinance.
Yes.
It's a great question. We've been describing the housing market as a tale of two markets. You've got activity in the existing home market pretty much frozen because, as you mentioned, people don't want to trade in their sub 3.5% rate for what's now 7.25%. On the other side, you've got the builders who have benefited because they've brought new supply to the market. They've been able to work with their buyers through offering lower mortgage rates. And to your question, what we've heard from a majority of the builders is that 5.5% mortgage rate is kind of the sweet spot where they've seen much more buyer activity. But, I will say that we've also heard as rates have started to creep up, not all of their buyers are using rate buy downs. Even from some of the larger builders like a D.R. Horton, you're somewhere around 60%. So there is some aspect that consumers have become more comfortable with higher rates. I mean, we've been at these elevated levels for, call it more than a year. So there has been kind of some degree of acceptance here among consumers. And, what they've had to do is kind of just adjust their expectations. Builders are also adjusting the size of their houses. That's another way that they could get to that monthly mortgage payment.
I wonder about the labor situation right now. Did we learn anything from Home Depot about that? Because I noticed on Sunday when I was in there, they had a lot of employees. Like, I was always able to get help in every aisle when I needed it, which is not my typical retail experience over the past year.
So actually, believe it or not, Home Depot has made this year a massive investment in its employees, for its hourly employees in the stores. Their model tends to flex with demand. So you'll see their staffing levels within their store adjust as demand ebbs and flows. But they have made that a concerted effort in investing in their employees because, the labor environment has been so tough over the last couple of years. We think that this is, it's the time to do it. While the market might not be as strong as it's been, now's a good time for them to get out ahead of it. So when things do rebound, they have the employees there.
So, when you think about building new homes, it doesn't seem like the builders are building what the market really needs. The market needs starter homes for people. Do we need another McMansion or subdivision of McMansions with the 5 and 6 bedrooms? Now, I understand that's where the profit margin is for the builders, but I'm wondering, is there any supply to meet that demand on the lower end?
So that's actually been an area of focus for the builders over the last couple of years. You've got names like D.R. Horton, Lennar, who are pretty big in the entry-level market. We think that's where most of the supply is going to come because that's really one of the only ways at this point where you could kind of help to bridge that affordability gap. You're seeing builders start to offer lower square footage plans that are more preferred by buyers. They're starting to take out some of the bells and whistles in the houses as well, which helps to lower that payment too.
What are the next data points, Drew, that you're going to be watching closely in terms of the housing market and, which direction to decide which direction we're moving here?
So it's going to be interesting to hear the next round of home builder earnings calls to see how this, resurgence in rates to 7.25% is going to impact the business. We just got data from the NAHB today, builder sentiment, and it's actually the first decline in several months. And a lot of that has to do with the fact that rates have risen so much, so buyer traffic is down. So if this situation persists, we would expect that builders are going to return to a more elevated use of sales incentives to drive traffic, which could impact profitability. So that's really what we're going to be listening to. How has this most recent rise in rates impacted the business?
It's pretty amazing. I look at the bank rate, 30-year mortgage, and right now, 7.51%.
Yeah, brutal.
Ouch.
Yes. So I thought I was getting rooked with my 6 handle, but I look kind of smart these days. Drew Redding, research analyst, covers all the home builders for Bloomberg Intelligence. Appreciate that. Getting that update on Home Depot. So motorcycles, Can you buy them, or are they also supply constrained?
They're
parts?
very supply. Well, it depends, I guess, on which manufacturer. I am a diehard Ducati fan. I think that's clear to everybody, right? That's not. I'm not being.
So you're not a
partial.
Harley Davidson guy, to put it in context.
I do. I love a lot of Harleys as well. But when I'm stocking up the Miller garage, it's usually with Ducatis. And
Are you not one of those guys that goes super fast, weaving in and out of cars on the Garden State?
not
Parkway?
anymore.
Okay.
No.
But you
no.
were back in the
But
day.
I still. I like more the touring bikes. You know, the taller bikes with more legroom. I can go off road a little bit. I can take them camping. But so the Multistrada is the bike that I love from Ducati, and there's I think a year-long waiting list.
Really, I can't imagine. Can't imagine.
Fortunately, I know a guy.
You know a guy, I'm sure, in Italy, I'm sure. S&P 500 off 1% here today. We are selling off. Same thing for the NASDAQ. Yields ticking up or ticking down a little bit right now. We've got the 10-year Treasury 4.17%. WTI crude oil off 2.5%, back down to $80 per barrel. Let's get the gasoline prices down next. Right now, with our news in New York City, here's Michael Barr.
Paul, Matt, thank you very much. It's 10:33 on Wall Street. Wildfires in Maui are now blamed for at least 99 deaths, and officials expect the number to rise. Bloomberg's Steve Rappaport with the story.
While search and rescue efforts continue, authorities are working to relocate residents displaced by the deadliest fires in the U.S. in more than a century. Governor Josh Green says the state is teaming up with area hotels to provide shelter.
We already anticipate at least 36 weeks of direct housing for individuals. It will probably go on much longer than that.
Green says state and federal disaster relief will pay for the housing. Meanwhile, investigators are looking into what caused the wildfires. Power lines owned by Hawaiian Electric are a possible culprit. Steve Rappaport, Bloomberg Radio.
A fourth set of criminal charges implicating former President Trump as the head of a sweeping conspiracy to overturn the 2020 election results in Georgia were announced by Fulton County DA Fonnie Willis.
The participants in association took various actions in Georgia and elsewhere to block the counting of the votes of the presidential electors who were certified as the winners of Georgia's 2020 general election.
Meanwhile, Carlos de Oliveira, the property manager at Trump's Mar-a-Lago estate, who is facing his charges in the classified documents probe, just pleaded not guilty to the charges brought by Special Counsel Jack Smith. And there's breaking news in the Hunter Biden case. According to CNN, his lead criminal defense attorney asked a federal judge today in Delaware for permission to withdraw from the case involving tax and gun charges. It is said because Christopher Clark could now be called as a witness in future proceedings. Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr, and this is Bloomberg.
Facts, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
$10:40 on Wall Street. I'm Amy Morris. Home Depot earnings exceeded the average analyst estimate, suggesting home improvement spending in the U.S. is performing slightly better than expected after an unprecedented boom during the pandemic. We talked about that with Bloomberg News home builder analyst Drew Redding.
There's still a lot of uncertainty out there with the consumer, so there's really no benefit to them upgrading their guidance at this point. We didn't hear a whole lot of new information, but what we did hear is them reconfirm that there is ongoing softness for big-ticket discretionary purchases, which kind of hints at some of the challenges that are facing the consumer.
Drew Redding with Bloomberg Intelligence. We check markets all day long here on Bloomberg Radio, and Home Depot shares are a little less than 1% higher. Dow Jones down 0.8% or 304 points. S&P 500 down just about 1% or 42 points. NASDAQ down 1% or 132 points. 10-year Treasury, 6/30 seconds, the yield at 4.16%. The 2-year yield at 4.9%. I'm Amy Morris. That's your Bloomberg Business Flash. Matt and Paul.
All right, Amy Morris, thank you so much. We appreciate it. Looking at yields here, I got the 10-year trading at 4.16%, and on a real yield basis, up to 1.83%. So that's the highest we've seen in a long time. What does that mean for these markets? Amal Darkar joins us. He's global head of corporates for Chatham Financial. He's been doing this stuff for over 20 years. He's got his MBA from some trade school down in Philadelphia. But certainly the key part of his resume for me is he's a Penn State graduate, chemical engineering and economics. Penn State, by the way, the football team is preseason ranked number 7, which is great to see, although I think it might be a little high. But anyway, Amal, thanks so much for joining us here.
That is so uncool.
Well, I'm a huge Penn State fan, but I just feel like 7 might be a little high.
That's too much?
They can earn their way into it. But
Amal, what do you say? Does 7 sound good?
We don't have enough time to talk about Penn State football. I think 7 sounds pretty good to start.
That sounds pretty good to start. All right, Amal, what are you looking at here? Again, I'm looking at the real yield on the 10 years. Some people like Lisa Bromwitz tell me that's important. We're here at 1.83. That's the highest it's been since, I think, like 2009 or something. So what do you make out there in the marketplace?
Well, nominal yields are pretty high too, and what we have seen is there's just been this adjustment in the market to coming around to the view that rates might be higher for longer. I mean, we saw the retail sales data out this morning that was quite strong, and again, the market is slowly adjusting, and multinational corporate CFOs, treasurers are starting to really try to understand what that means for them as they look forward.
So is your sense that we are, in fact, in for kind of a soft landing, that maybe the Federal Reserve has kind of done a pretty decent job here?
Well, that's what the markets seem to be feeling right now. Remember all that talk of the Goldilocks ending to this inflation story a year or so ago. There was a lot of naysayers on that. And right now, the markets seem to be adjusting to the possibility that the Fed has, in fact, stuck the landing. There's a lot of room to go here. And again, I think one of the big challenges for risk managers out there, for CFOs and treasurers, is looking at that and saying, well, what does this mean? I have certainly a significant amount of maturity coming up. When you look at both investment grade and high yield bonds, how should we finance ourselves in a very different market environment than any of us have seen in over 2 decades?
In a much more expensive way, I'm guessing, right? I mean, if you're financing a deal now or if you're refinancing existing debt, you're going to just be prepared to pay more.
That's right. It's not just home mortgages that are north of 7 anymore. And everything has gotten a lot more expensive. And so it's led to what we often see in financial markets is lots of innovation. One of the biggest areas of innovation we've seen is the growth of private capital. So not necessarily bank lending, but now we have all these funds out there, as you've probably reported on many times, that's creating new sources of liquidity for a lot of mid-market and even large cap type of firms or infrastructure projects. It's been a pretty dynamic change in the lending environment that we've seen amongst our clients.
And I mean, we're expecting that to continue to grow, right? The private capital, private lending is a business that just keeps getting bigger.
Absolutely. It keeps getting bigger, and it will be really interesting to see what happens once banks resume, as as firms start to really underwrite that, there's a bit of a recession that could come, but maybe it's not going to be too strong of one. Banks come back into the market. There's a lot of competition from private capital. You wonder how quickly the credit cycle can turn and whether institutions are going to be able to refinance into maybe not better rates, but possibly better terms than they could otherwise get.
Hey, Amal, I mean, if I were to come back and restart my career on Wall Street, I would definitely look at the private credit business because it just seems to be such a fast-growing part of the marketplace. But Jamie Dimon and others have called out, hey, but these guys are kind of like a shadow banking system. They're not really regulated, and man, there could be some real problems there. Are you concerned about that, about kind of how much capital is going to the private credit market?
I think the private credit itself is just a continuation of a trend that we've seen in finance over many, many decades. There are places where there are different institutions that are better poised to offer liquidity for different firms. As we look forward, though, there are going to be some challenges for private credits. They don't offer the full services that banks do. At Chatham, we work in the debt and derivative space, and one of the places that a lot of borrowers get into some challenges with private credit is they might be able to borrow on a floating rate basis from private capital, private debt funds, but they may not be able to actually hedge their risk as effectively as they could if they did borrow from a bank or a syndicate of banks. And so, especially in a rising rate environment, that can create some incremental friction, some incremental costs, or some incremental risk that firms don't really want to take on.
So, Amal, I know you guys at Chatham, you talk to a lot of the largest corporations in the world and about their hedging programs. What kind of hedging programs are you focused on, or are you hearing from your clients that they need expertise on? Is it interest rates? Is it currencies? Is it commodities, or some combination?
It's all three of those, actually. And one of the biggest areas, of course, for the last year has been around interest rate risk management. Lots in the news. But if we rewind to about a year ago, you might recall that FX was pretty big in the news. The euro was below parity around this time last year. Sterling, they were going through a run of prime ministers very quickly. That was making its way towards parity. Since then, the dollar has weakened, which has led to a little bit of complacency amongst very large cap and multinationals. But there are some other interesting areas to look at as well. Probably the other big theme that we've seen from these multinationals is looking for places where they can reduce their cost of funds. So back to higher interest rates in the U.S., there are other places around the globe that are actually cutting interest rates. China, as we all saw this morning, is one of them. And that's leading to some interesting opportunities for firms to do some arbitrage, for lack of a better term, between dollar funding and could be funding in other currencies.
Amal, let me just finally ask you what you like in corporate credit. Are there areas that you and Chatham find attractive right now?
We're not too focused on the credit cycle at this time. I think one of the big questions that investors are asking is how are these firms actually managing their risks, especially as we go into the possibility of some type of a downturn. We recently did a study, and we found that an interesting fact is that newly public companies tend to manage their risk less proactively than firms that have been public for a longer period of time. And I think that's an interesting area that investors are going to be paying more and more attention to as we go forward.
All right, Amal, thanks so much for joining us. Really appreciate getting some of your time. Amal Darkar, Global Head of Corporates for Chatham Financial. And despite its name, it's not based in Chatham, New Jersey, or Chatham, Massachusetts.
I was looking that up as well.
It's outside Philadelphia. Go figure.
I see that.
Talking about the
Square.
Yeah, right outside Philly. So again, going back to Penn State football, preseason ranked number 7. That's great. But it's all dependent upon some 20-year-old quarterback kid that we know nothing about, really.
That's how it always is in college football.
In college football. So we'll see how that goes. College football will be interesting this year. Somebody wrote that it'll be the last year as college football as we know it, because it's next year's when all the super leagues start, and it's just going to be different, I guess.
Yeah.
So the Big Ten's got like 40 teams in it and stuff like that. It's crazy out there.
Different and is worse?
In my mind, definitely worse, because I think one of the real values to college football are the rivalries. Unlike professional, it's just the rivalries. This is Bloomberg. let's get some company news with Lisa Mateo.
And I'll be rooting for Rutgers. That's right.
There you
Good
go,
morning,
Sanjay.
everyone. Yeah, company news today. A federal court in Minnesota. It's rejected Delta's claims that actions it took cited by a female pilot were for her benefit and not retaliation. Bloomberg's Steve Potisk has that story.
According to Andrea Ratfield, she was retaliated against for complaining about gender bias and harassment, including by being forced to undergo retreatment for alcohol abuse and threatened with termination. According to the judge, the allegations sufficiently state a hostile work environment claim under the Minnesota Human Rights Act. The court dismissed gender discrimination claims.
Delta shares right now down about 2%. Today, the Writers Guild of America and Hollywood Studios are scheduled to meet again to hammer out details of a new proposal. Bloomberg's Steve Rappaport has more.
Lisa, Hollywood Studios have made a new offer to striking screenwriters. Sources tell Bloomberg the proposal from the Alliance of Motion Picture and Television Producers ensures human writers will not be replaced by artificial intelligence. It also gives them access to viewer data on streaming so they can see how popular their programs are. Netflix and Disney have been pushing for an agreement to end the impasse that started 3 months ago when writers dropped their pens